Hi friends, so welcome to CA Final paper number 2 Strategic Financial Management RTP for November 2022. Now I'm very happy to share with you that all the questions asked in this RTP, 100% of it are from my online pre-recorded course which is available at online.jkshaclasses.com. So what I'll be doing is I'll be pulling out videos from that particular course. I'll be compiling it exactly in the sequence of the RTP for this November 2022 and I'll be presenting it in front of you in this video itself. So all the best. This is question number 1. Hi friends, so let's do one more question on this share repurchase and buyback module. Question 29 students, this question is there in the old practice manual. In new May 19 paper it came for 8 marks, in May 2006 paper 6 marks, November 10 paper 8 marks. It's also there in the RTP in November 17. So quite many places. Rahul Limited. Okay, I request everyone to please pause the video and read the question carefully. Start. Okay students, I hope you all read the question. Let us now try to understand it. Rahul Limited has a surplus cash of 100 lakhs and wants to distribute 27% of it to the shareholders. The company decides to buy back shares. The finance manager of the company estimates that its share price after repurchase is likely to be 10% above the buyback price if the buyback route is taken. The number of shares outstanding at present is 10 lakhs and the current EPS is 3. You are required to determine. Let's do point number 1 only, 2 and 3 we'll see later. The price at which the shares can be repurchased if the market capitalization of the company should be 210 lakhs after the buyback. Yes, so let's start understanding. What are they saying? Rahul Limited has how much surplus cash? 100 lakhs. So I'll write down here surplus cash, okay, equal to rupees 100 lakh. Then they're saying wants to distribute 27% of it to shareholders. So can I say distribution, okay, to shareholders will be 100 lakhs, correct, into 27%, which is equal to 27 lakh. Everybody following? Yes, this is 100 lakh rupees surplus he has. Out of that, 27 lakh he will want to give out. 27% given in the question. So 27 lakhs he wants to distribute, which means if he's going for the buyback route, can I say he will be wanting to buy back shares worth 27 lakh, correct? Basically, they are ready to shell out 27 lakhs and repurchase the shares, correct? Let's now read ahead. The company decides to buy back the shares. The finance manager of the company estimates that its share price after the buyback, after the repurchase, is likely to be 10% above the buyback price if the buyback route is taken. So students, if I say let the buyback price, okay, let the buyback price be rupees X per share, which means at X rupees per share we are buying back the share. Can I say therefore post buyback share price, okay, post buyback share price will be, they are saying it is going to be 10% above the buyback price. So can I say it is 1.1x, correct? X means 1x plus 10% means 1.1x. Everybody following? Let's now read ahead. The number of shares outstanding at present are 10 lakhs. So can I say that pre-buyback number of equity shares are 10? And then they're also telling you and the current EPS is 3, which means students, can I say that my pre-buyback EPS is rupees 3. Everybody following till here? Pre-buyback number of equity shares is obviously 10 lakhs. 10 lakh shares we have pre-buyback and the pre-buyback earnings per share is only rupees 3. Everybody following? So what are they asking? You are required to determine the price at which the shares can be repurchased. Basically, you have to find out this X, that is the buyback price. Then they're saying if the market capitalization of the company should be 210 lakhs after the buyback, which means they're saying, see, market capitalization means what? Total number of equity shares into the market price per share is called as total market capitalization value. We call it as total market cap. Everybody following? It is nothing but the total number of equity shares into market price per share. Can I say market price per share is the market price of one share? If I multiply by the total number of equity shares, we get the market price of the entire equity, which we call as market cap. That is market capitalization value. Everybody following? So they are saying that the market capitalization value post buyback is going to be 210 lakhs. So I'll write down post buyback market cap is 210 lakhs. We have to find this X. How will we find the X? Very simple. Students, can I say that post buyback market cap of the entire company will be nothing but post buyback number of equity shares into post buyback market price per share. Everybody following? So this is the equation that we have to follow. Can I say LHS we already have is 210 lakh. I am again repeating, market cap means what? Market cap means total number of equity shares multiplied by market price per share. So if they are giving to us the post buyback market cap as 210 lakh, that will be nothing but post buyback number of equity shares outstanding into the post buyback market price per share. Everybody following till here? Can I say, students, post buyback market price per share we already have. Yes, post buyback share price we have taken as 1.1x under the assumption that the buyback price is x. Everybody following? So can I say here I will write 1.1x. Now into what? Post buyback number of equity shares. Students, can I take post buyback number of equity shares as same as the pre buyback number of equity shares, 10 lakhs? No, because from this some number of shares we are repurchasing, buying back. Now do you realize that post buyback number of equity shares will be 10 lakh minus some shares that you buy back, correct? Now one thing I know, that I am buying back shares worth rupees 27 lakh, correct? Because that is the money I want to distribute, and one share buyback price we have taken as x. Can I say therefore the number of shares that we would want to buy back would be 27 lakh divided by x. Everybody following? So 27 lakh divided by x are the number of shares we want to buy back. 10 lakh, students, are your existing shares. So 10 lakh minus 27 lakh divided by x will give you your post buyback number of equity shares, which I will write down here. 10 lakh were my original pre-buyback shares, minus we are buying back shares worth 27 lakhs, correct? And one share buyback price is rupees x. So the number of shares you'll be buying back is 27 lakh divided by x. So 10 lakh minus 27 lakh divided by x will give me my post buyback number of equity shares. Everybody following? Now we have to just open up this equation and solve the question, correct? Let's start. So 210 lakh is equal to 10 lakh x minus 27 lakh divided by x into 1.1x. Everyone understanding? So students, in this I am very sure you understand x and x will get cancelled. Next I will write down 210 lakh is equal to, now this 1.1 if I multiply by 10 it will be 11 lakh x minus, so if I multiply 27 into 1.1 I'll get 29.7, so minus 29.7 lakh, correct? Students, what will I do now? 210 lakh plus 29.7 lakh is equal to 11 lakh x. So 210 plus 29.7 will give me 239.7 lakh is equal to 11 lakh x. Everyone understanding? Can I say therefore x is equal to 239.7 lakh divided by 11 lakh. So if I divide this by 11, I'll get 21.8. Students, 21.8 is what? It is the value of x, correct? Value of x means basically this becomes your buyback price. Everyone understanding? The actual value we got is 21.79. I just rounded it off to 21.8. Everybody clear with this? So students, with that we found out the value of x. If you remember, I'll again show it to you. The value of x was nothing but the buyback price, correct? Let the buyback price be x. So x we got as 21.79, which is nothing but our buyback price, correct? Let us now read ahead. They are asking you number of shares that can be repurchased. Students, we are distributing 27 lakh rupees, correct? So we are going to buy back shares worth 27 lakh rupees. Therefore number of equity shares to be bought back would be 27 lakh divided by x, correct? We had already taken the same as the number of shares to be bought back, 27 lakh divided by x. The x value we got is 21.8. So 21.8 is the per share buyback price. Total we want to buy back shares worth 27 lakh rupees. So 27 divided by 21.8 if I do, we will buy back round off 1.24 lakh shares. Everybody following? So 1.24 lakh shares are rounded off. These are the number of shares that we will be buying back. This is point number 2 done. Point number 3, the impact of share repurchase on the EPS, assuming that the net income is the same. Students, can I say my EPS pre-buyback was 3. My number of equity shares pre-buyback was 10. Can I say pre-buyback net profit was 10 lakh into 3, that is 30 lakh. Everybody following? And they are saying that the net income will continue to remain same. So can I say my post buyback EPS will be 30 lakh income will continue. Do you realize my post buyback number of equity shares would be 10 lakh minus 1.24 lakh, correct? Because from 10 lakhs, 1.24 lakhs you are buying back, that is 30 lakh divided by, students, 10 minus 1.24 will give us 8.76 lakh shares. So 30 lakh is the total net income. 8.76 lakhs are the post buyback number of equity shares. So 30 divided by 8.76 will give us the final EPS as 3.42 rupees. Okay, from 3 it has grown to 3.42. There has been an increase in EPS due to the buyback. Obviously there will be an increase because the net income is same and the number of shares are reducing, correct? It had to be an increase in EPS. No great science is required to know why the EPS increased, correct? So simple question, students. With this we complete this question 29. I hope you understood this question. I'll now flash the solution of this question on your screens. You can pause the video and copy down the notes. Thank you so much. See you in the next video with another question. Hi friends, so now that you know what bond refunding is and also you have understood how to calculate incremental NPV by making the two project details. I hope you saw the previous two videos. Let us now start a sum, question 40 from the practice manual. Students, I request everyone to please pause the video and read the question carefully. Start. Okay students, I hope you all read the question. Let us now try to understand it. Don't panic, I'll explain everything to you. Okay, let's start. ABC Limited has 300 million 12% bonds outstanding with 6 years remaining to maturity. Let us understand this one line only. What they are saying, ABC Limited has, is a company called ABC Limited. It already has a 300 million rupees bond outstanding which it must have issued sometime in the past, and the interest it is paying, the interest rate at which it is paying the interest is 12% per annum with 6 years remaining. Students, we are not concerned when it issued this bond. We now know that from here 6 years are left for this existing bond. I hope you understood. This is the existing bond we already have. Since interest rates are falling, as I've explained to you in the past, the whole concept base is this, that yes, when we issued the bonds, the fixed interest rate bond that we issued, at that time the interest rates were high, but today now the interest rates have fallen. Today if we issue a new bond, we will be able to raise money at lower interest rate. So similarly they are saying here, since interest rates are falling, ABC Limited is contemplating of refunding these bonds with another 300 million issue of 6 years bond carrying a coupon rate of 10%. What is the meaning of this? They are saying that today the interest rate has fallen from 12% to 10%. So today if I issue a new bond, do you realize that we will be therefore required to pay only a 10% interest? So today let us refund the original bond in which I am paying 12% interest and let us replace it with a new bond having only 10% interest. So we raise a 300 million new bond, and with the proceeds of this new bond we will knock off the original bond. Everybody following? Will refund the original bond and close that matter, and this new bond will start with an interest rate of 10% per annum. Everybody following? And of course the life of this new bond has to tally with the remaining life of the existing bond, that is 6 years. Everybody following? The issue cost of the new bond will be rupees 6 million. Children, do you remember when you were in IPCC or Inter CA, in cost of capital chapter, we had this concept called as flotation cost. Remember that when we issue the bond, when we issue new equity shares, when we issue new preference shares, there were some issuing costs which we used to call as flotation cost, the cost which is required to be incurred one shot at the start, at the beginning of the issue to float the debentures in the market. Those flotation initial expenses they are saying will be 6 million, and the call premium is 4%. Children, what is this call premium? Call premium means when you are refunding the existing bond. Can I say in one sense you are calling back the bonds? Yes. So when we call back the bonds, I hope you people understand we have to pay back their money. So when we pay back their principal of 300 million on the existing bond, we are also going to give them a premium of 4% over and above. Everybody following? Over and above the 300 million face value. Yes. So students, they are saying that when we refund the bond, when we call that bond back, which bond? The existing bond, when we call back, we are going to give them a 4% additional amount, that is called premium. Everybody following? This is of course an allowable expense also. Please remember this. Let's read ahead. They are saying 9 million being the unamortized portion of issue cost of old bonds can be written off no sooner the old bonds are called off. Children, this line I will explain to you during the solution. Right now don't worry about it. Okay, very simple adjustment is there. They are saying marginal tax rate of ABC Limited is 30%. This is the tax rate. You are required to analyze the bond refunding decision. Cost of capital is 10%. As we discussed in the previous video, we will be doing the incremental NPV calculation directly using incremental cash flows. One shot NPV we will do. But when we are making the project details, we will be making the PDs, the project details of both separately. Both separately means what? One item is if the new machine is purchased, existing machine is sold today. And the other item is if the existing machine is continued, which means in our question here, the first project detail will be if the new bond is issued today, that is the existing bond is refunded today, and the second project detail will be if the existing bond is continued. Everybody following? Let us first make the project details and then we'll do the incremental cash flow calculation to find out the incremental NPV. If the incremental NPV is positive, we will say refund the existing bond and replace with the new one. Everybody following? Let us now start. Students, question number 40. I'll write down here first of all project details. Okay, project details. Students, tell me in project details what I'll write. First of all, I'll write down here if new bond is issued. Okay, if new bond is issued today, that is the existing bond. Are you paying attention? Existing bond is refunded today. Okay, existing bond is refunded today. This is one option. The other option, students, of course, is if existing, yes, if the existing bond is continued. Yes, if the existing bond is continued. So children, let's go back to the question and let's see what all cash flows will happen. Students, please pay attention. I'll read it again. ABC Limited has a 300 million 12% bond outstanding with 6 years remaining to maturity. One thing we know, whether I continue my existing bond or I go for the new bond, my life is going to be 6 years only. 6 years calculations I have to do. Since interest rates are falling, ABC Limited is contemplating of refunding these bonds with the 300 million issue of 6 years bond carrying a coupon rate of 10%. Students, do you realize the most important project detail now in this particular section now I'm writing? First of all, we will be issuing a new bond. So I'll write down here new bond issued. Okay, new bond issued. Of course, today 300 million rupees will get. That is an inflow for us. And immediately we will also existing bond refunded. Everybody following? Existing bond refunded today only, which means 300 million, can I say, we will raise and we will take that money and refund the existing bond. Of course, apart from this, we'll also be paying a call premium that I will show as a separate cash flow to you. Okay, students, apart from that, do you realize they are saying that if you go for the new bond, are you listening to me? If you go for the new bond, you will have to pay interest at the rate 10% only. So I'll write down here interest rate. Okay, interest rate is how much, students? 10% per annum. Children, do you therefore realize this will result in a cash outflow of interest every year? And I'm very sure, considering that you are all done with your IPCC inter CA, you know that interest is an allowable expense, right? And if interest is an allowable expense for tax, the post-tax savings interest can be written as interest into 1 minus T. I hope you have done capital budgeting, cost of capital, all these chapters is 1 minus T was there, right? So interest is the outflow, interest into tax is the tax saved by the interest, therefore interest into 1 minus t is the post-tax saved interest. Everybody following? Post-tax saved means there is some interest you pay, or that interest saves tax for you. So post that tax savings, what is the net outflow is interest into 1 minus t. That is of course an outflow for me here. Everybody clear? But of course at the rate 10%. What all will happen if you go for the new bond? Let's read ahead. They are saying issue cost of the new bond will be 6 million. Children, these are your flotation costs. So let us write it down as an outflow here. I'll write down here flotation cost outflow. Now children, some of you might think, sir, flotation cost, is it also an allowable expense? I will say yes. Sir, if flotation cost is an allowable expense, then why you're not writing into 1 minus t to also factor in the tax savings? Very good question. I'll tell you what it is. Students, flotation cost is like a preliminary expense. Everybody following? Flotation cost is like a preliminary expense which is incurred one shot today. But do you realize its benefit will be received by you for the coming 6 years? Therefore, we will have to amortize the flotation cost over the next 6 years to avail the tax benefit. Everybody following? Which means flotation cost that you incur today, do you realize it will not be recognized entirely today itself, because this initial cost, this preliminary expenditure, do you realize has its impact over the 6-year period? Because of this flotation cost, it's a preliminary expense for our next 6 years. Hence, we will amortize this flotation cost for tax purposes, and therefore we will definitely get tax savings, but not one shot on flotation cost today, but on the amortized flotation cost over the next 6 years. Just as in normal capital budgeting, students, you used to purchase a fixed asset. A fixed asset, when you purchase, do you take the tax savings on that capital cost today itself? No, that capital cost is amortized over the life of the asset in the form of depreciation, and then on depreciation, on an amortized form, you get tax savings, right, throughout the life. Similarly, this flotation cost is like an initial cost, a preliminary expenditure incurred today, and on that preliminary expenditure, we will save tax, but not one shot today, because it is to be recognized over the life. Hence, we will amortize the flotation cost, and on this amortized flotation cost, students, we will definitely be getting the tax savings in each of the 6 years. Everybody clear? So students, my next item obviously will be tax saved. Are you listening? Tax saved on amortized flotation cost. Yes, tax saved on amortized flotation cost per annum calculation. It is of course an inflow for me. It's an inflow tax saving. Everybody clear? Let's now read ahead. Students, and they are saying the call premium is 4%. Students, call premium means when you are refunding the existing bond. Are you listening to me? When you are refunding the existing bond, you are not only knocking off their principal, you're not only paying the principal, you're also giving them a call premium. Everybody following? That of course is an expenditure for me. So children, I will write down here call premium. Tell me, when is it paid, call premium? Of course, the call premium is paid today only when you refund the bond. Now, one thing you should understand, call premium of course is an allowable expense for tax also, and therefore we will take the tax savings also into consideration. This becomes your net of tax savings call premium as an outflow, very similar to the interest calculation. The only difference is this interest here, I hope you understand, will be done on a per annum basis. Call premium is one shot to be done today itself. Some of you might ask, sir, why is the call premium not being amortized? Of course not. This call premium, tell me, this is an expenditure incurred for the new bond for 6 years or to knock off an old bond? Of course, knock off an old bond, correct? So this call premium that you are incurring is not some preliminary expenditure for next 6 years. It is the end expenditure of an original bond, and therefore the entire thing will be recognized in this year only, because that bond ceases to exist once this call premium is paid, that is today, and therefore this entire call premium will be recognized for tax purpose at the beginning of year 1 itself, and one shot, therefore I'm writing into 1 minus t. Everybody clear with this? Let us now read ahead. Students, then they are saying this particular bracket which I have not yet explained to you, and I think after reading this we have more or less knocked off everything, all the cash flows which will happen if you go for the new bond today. Are you listening to me? Yes. Now students, let us go to the next side. The next side is, if the existing bond is continued. Students, use your brains if any and tell me, if the existing bond is continued, what cash flow will happen? The most important cash flow is the interest will continue to pay. Everybody following? Today there might be nothing, but the interest you will continue to pay. Are you listening? Students, do you realize that if you continue the existing bond, the interest rate applicable is 12%. So I'll write down here interest rate, okay, I'll write down here, interest rate, yes, is 12% per annum, and therefore interest into 1 minus t will be an outflow in this particular project detail every year at the rate 12%. Everybody clear with this? Now, students, before I explain that bracket which I have not yet explained to you, do you realize that if I go for the new bond, then this, of course, existing bond is refunded today, but this new bond also will have to be redeemed right at the end of the 6th year. So of course there will be a redemption value of 300 million at the end of year 6, which will be an outflow. But children, do you have the intelligence to understand that even if I continue the existing bond, which is also having a face value of 300 million, here also a redemption value will have to be done at the end of 6th year, which means if I go for new bond, I have to do redemption at the end of 6th year of the new bond. If I continue the existing bond at the end of 6th year, I anyways have to do the redemption of 300 million at the end of 6th year. Do you realize this cash flow and this cash flow, do you realize, is of not much importance here, because it is going to happen in both cases, so will not impact your decision making. Everybody clear with this? Yes, so I am not taking this into consideration because it is a common cash flow between both the project details. Everybody following? Now students, coming to that bracket. Students, coming to that bracket, let me explain to you what that bracket is all about. They are saying 9 million rupees being the unamortized portion of issue cost of old bonds. Students, do you realize that when you are issuing the new bond, today you are investing 600 million as the flotation cost? Everybody agree with this? And this flotation cost, I hope you understand, we will be amortizing over the 6-year life of the new bond, correct? Similarly, when this existing bond must have been issued in the past, at that time also, on the first day of the issue, there must have been some cost of issue, some flotation cost which must have been incurred by this company then, correct? And that flotation cost must also be amortized over this existing bond's total life. I hope you're able to understand. Just as in the new bond, you're incurring a flotation cost today and you're amortizing it over the life of 6 years for the tax purpose. Similarly, in the existing bond, when the existing bond was issued, at that time you must have incurred some flotation cost for the issue of that existing bond, and that flotation cost must have been amortized over the life of that existing bond for the purpose of tax. Everybody clear with this? Now my question to you is, today, as on today, the existing bond, do you realize, still has 6 years left? Everybody following? It still has 6 years left, and therefore I hope people understand that the original flotation cost of the existing bond is completely not amortized. There are 6 years still left for amortization, and therefore this 6 years worth of flotation cost has not yet been taken for the purpose of tax saving calculation. I hope you are understanding. So students, what they are saying is that we were amortizing that flotation cost of the existing bond over its life, but now 6 years are still left. Those 6 years worth amortizations are still left, but if today only I knock off the existing bond, I refund it, they are saying that, you know what, 9 million unamortized is still left. I hope you people understand. 9 million worth of unamortized flotation cost, which is to be offered for tax saving purpose, is still left. I hope you people understand. So children, do you therefore realize that just as in the new bond, you are saving tax on amortized flotation cost. Similarly, if you continue the existing bond, on it also, even though flotation cost you are not incurring today, flotation cost is a sunk cost, you incurred it in the past, but on that for the coming 6 years, do you people realize you will be saving tax on the amortized flotation cost? I hope you understand. So I'll write down here also, tax saved, okay, tax saved on amortized flotation cost will be an inflow. Yes. Now one last adjustment. Children, do you realize that if you refund the existing bond today only, if you refund the existing bond today only, I am not talking of if you continue the existing bond. This is a separate affair. This is a separate affair. If you decide to issue new bond and therefore complete knock off the existing bond today only, then children, do you understand? Do you understand that as far as the unamortized part of flotation cost of the existing bond is concerned, you cannot amortize it further because the bond itself ceases to exist. Everybody following? I'll repeat again. The existing bond you are refunding, correct? The existing bond that you are refunding today, on that existing bond there is an unamortized flotation cost left which was to be amortized over the next 6 years. But that existing bond, if it is completing today only, if you are refunding it today only, if it ceases to exist from today only, how can you amortize it for the next 6 years if the bond only ceases to exist? Everybody following? Therefore, in this case, the entire unamortized flotation cost will be recognized for tax saving today itself in this option. Today itself, because the bond ceases to exist, right? If the bond ceases to exist today only, whatever unamortized flotation cost is there will be recognized for tax savings today itself. Yes, so therefore I will write down in this particular option, if we decide to issue the new bond today and refund the existing bond today, do you realize there will be a tax saved, okay, tax saved on unamortized flotation cost of existing bond today. Everybody following? Tax saved on unamortized flotation cost of existing bond today, it will be an inflow. It is so simple. See, I have an unamortized flotation cost which is to be offered for tax saving today. If I decide to continue the existing bond, I will get tax saving, yes, over the next 6 years on an amortized flotation cost. If I decide to stop that bond today only, if I decide to refund that bond today only, the bond ceases to exist, then the entire chunk of unamortized flotation cost, I'll get one shot tax saving today itself if I decide to refund the existing bond today. Everybody following? So basically this item and this item is same. It is just that in this item we are going to get the tax savings in an amortized manner over the next 6 years. In this case, however, one shot only will get because the bond ceases to exist today. Everybody clear? Students, apart from these adjustments, some common project details are there. The common project details are life, of course, students, we understand is going to be 6 years. Yes, life is going to be 6 years. Tax rate given to you in the question is 30%. So I'll write down here tax rate 30%. And the last, students, of course, is cost of capital, which will be our discounting rate for calculating the incremental NPV. Children, in this question, I am right now taking a decision to make this question a little complicated for you. Can you see here that they have given to you the cost of capital? I am removing this line from the question because I want to make it a bit complicated for you. Please pay attention. Gone. Okay, I have removed that cost of capital line from your question. I'll give you reason why. Students, right now I just thought of making it complicated for you because, students, sometimes the institute gives, most of the time it gives cost of capital, sometimes rarely it doesn't give cost of capital. So students, you should know what to do when cost of capital is not given, because, students, as far as this particular module of bond refunding is concerned, 3 questions I've put, 2 more coming up, of course. In all 3, cost of capital is there. But, students, there should be some question, right, in which you should know what to do if cost of capital is not given. So, students, don't worry, when the textbook will be given to you, this line will not be there, no cost of capital, okay. So, students, what to do when cost of capital is not given? In a bond refunding scenario, students, you know what to do. We have studied in our childhood. COC, do you realize, will be interest rate into 1 minus T. KD, you remember, in cost of capital chapter you have done this, interest rate into 1 minus T. Students, institute straight away does this. What is the interest rate of the new debenture? Students, the new debenture interest rate is 10%. So straight away 10% into 1 minus 0.3, which is equal to 7%. Students, 7% should be taken as the cost of capital. Game over. If the question gives you cost of capital, take it. If the institute doesn't give you, the question doesn't give you cost of capital, then straight away take the post-tax interest rate as the cost of capital. Everybody following? So students, don't worry, when I will be giving to you the question 40 in your notes now, at that time the question will end here. Don't worry about it. Everybody following? So students, with this we have completed our project details. I will now remove the unnecessary markings from this and we will start the incremental NPV calculations. Yes, let's start. Okay students, so I have removed the unnecessary markings. Let's start. Let's start calculating the incremental NPV, that is NPV this minus NPV this. But if we want the one-shot NPV calculations, then we will do directly using incremental cash flows, that are cash flows in this minus the cash flows in this. Can we start? Students, I am writing down here now calculation of incremental NPV. In that I am writing present value of cash inflows, and then on the next page I will write down minus present value of cash outflows. Yes students, so now let's look at the project details and knock this question off. Students, I hope you remember for incremental cash flows we will need this side cash flow minus this side cash flow. In the previous video I have taught you all the rules. Let us now try understanding. The first item is new bond issued, inflow because of course if you are issuing a new bond of 300 million, I hope you remember, it will be an inflow for you today. Corresponding, can you see there isn't any such cash flow happening in the existing bond, so the corresponding cash flow is 0, which means this itself will become an incremental cash inflow. CI is there if you go for the new bond, CI is not there if you continue the existing bond as far as new bond issued is concerned. So that new bond issued cash inflow today is in itself the incremental cash inflow. I hope you understand. So students, I will now write it in the PV of CI. Yes, in PV of CI I'll write down new bond issued. Okay, new bond issued. Tell me how much? 300 million. Of course 300 million into 1. Why into 1? Because it is happening today. Discounting factor will be 1, so 300 million into 1 will give you 300 million as the PV of CI. I hope you people are all understanding. Let's go to the next. Students, the next one is, if you check, existing bond refunded. Students, the existing bond also will be refunded today only if I go for the new bond today. 300 million is the principal value which we are refunding. Of course we are giving a call premium also, but that outflow I'll show separately. Right now let us knock this off, and of course as you can see there isn't any corresponding cash flow of the same nature same time, so this cash outflow in itself becomes the incremental cash outflow. So the existing bond refunded only the principal amount. How much will take? 300 million only will take. So students, in PV of CI I will write down here existing, okay, existing bond refunded. Okay, existing bond refunded. How much students? Existing bond refunded also 300 million, and because it is happening today, into 1 discounting factor will give us 300 million as an outflow. Everybody following till here? Let's go to the next. Students, the next item is interest rate. Of course interest rate in itself is no cash flow, but the interest will be a cash flow. Children, I hope you people understand that as far as this particular segment is concerned, students, the interest that you will be paying is 10% per annum. Corresponding, there is an interest which you will be paying at the rate 12% per annum. Children, therefore can I say you will have to do the incremental cash flow now. There is a CO, a cash outflow, at the rate 10%. Here there is a cash outflow at the rate 12%. Can you see the incremental cash outflow is not at the rate 2%, it is at the rate negative 2%. Negative 2 means what? If I go for the new bond, I will have to pay a 10% interest. If I continue with the existing bond, I have to pay a 12% interest, which means by replacing I am saving 2% interest. I hope you people remember my previous video explanations. So children, do you realize as far as interest is concerned, there is a saving in interest at the rate 2%. In fact, because of this saving, we are going for the refunding. This saving of interest is the most important cash flow in your calculation. Yes, so savings means, students, I am very sure you know where to write. We will write it in the CI column itself. Yes, even though both are outflows, I hope you understand the outflow in the new bond is lower, hence there is a savings. So children, I will now write down in PV of CI, I will write down savings. Okay, savings in interest, savings in interest. So I'll show you the calculations now. See, please pay attention. 300 million is the principal amount. On 300 million, students, do you realize you will be saving 2% per annum into, of course, 1 minus 0.3, that is post-tax savings. And students, these savings will happen not for 1 year. It is not, of course, happening today. I hope you understand. It will be happening at the end of every year for the next 6 years. So for the present value, I'll have to multiply this by PVAF. Yes, PVAF of the discounting rate, as we know, cost of capital is 7% for 6 years. Everybody clear with this? So now let's take the calcs and solve this. Okay students, so first of all let us calculate the PVAF of 7% 6 years. 1 divided by 1.07, 1, 2, 3, 4, 5, 6. Students, it comes to 4.766. Okay, so we'll write it down somewhere here only. Yes, PVAF of 7% 6 years is 4.766. Okay, 4.766. Can we go ahead? So students, let's now take the calcs and solve this now. So 300 million into 2%, yes, into 0.7 into 4.766 will give us 20.0172. So I'll write down here, yes, it is 20.0172 million. Everybody following till here? So students, what we have done is savings and interest on 300 million, 2% per annum we have saved. Into 0.7 I did to take into consideration the 30% tax savings of interest and multiplied by PVAF of 7% 6 years, because these savings and interest are going to happen for the next 6 years at the end of each year for the next 6 years. Everybody following till here? Students, with that we complete our interest calculations also. Yes, so with that we have completed interest also. Let's now go ahead. Now what is left? Interest is done. Yes. Now as far as the new bond is concerned, the next item is the flotation cost. Children, can you see as far as the corresponding cash flow is concerned, there isn't any flotation cost happening today. Yes, in the existing bond, flotation cost had happened in the past. Sunk cost, it is correct. Today, if I continue existing bond, today I have to pay no flotation cost. But if I go for the new bond today I will have to pay a flotation cost. Students, how much flotation cost we are paying? We are paying a flotation cost of 6 million. The entire 6 million one shot we are paying today. So for us, it is an outflow. In itself becomes an incremental outflow because there isn't any corresponding cash outflow if the existing bond is to be continued. Everybody following? So students, what we will do is straight away we'll go to PV of CO. We will write down flotation cost on new bond. Okay, flotation cost on new bond, as the amount is 6 million, we will write down here 6 million into 1, that is 6 million. Everybody following till here? Let us now go to the next cash flow. Students, the next cash flow, if you see, is the tax saved on amortized flotation cost. These are the flotation costs of the new bond itself, correct? The new bond flotation cost of 6 million, which we will be amortizing over the next 6 years. On those amortized flotation costs, every year we will be getting some tax savings. These are obviously cash inflows for us. I hope you understand. But children, you should also pay attention here. Can I say, if you continue the existing bond, there are also tax savings on amortized flotation cost. On the flotation cost of the existing bond, you will anyways get. So children, do you realize same nature, same timing, two cash flows are there. We will have to do the incremental cash flow just as we did for interest. In interest also we did incremental, right? Here we are paying interest at the rate 10%. Here we would have paid interest at the rate 12%. So incremental savings in interest came. I hope you understand. Similarly, this tax savings also we will have to do incremental. Now when we calculate the incremental tax savings, incremental tax savings, when you do, which is these tax savings minus these tax savings, if the answer is positive, it is incremental cash inflow, right? Because this is a cash inflow, this is a cash inflow minus cash inflow, the incremental cash inflow you will get. But if the answer is negative, then I'm very sure you remember that if it is a negative cash inflow, it means it is a cash outflow. It is, again, if you remember, as per my previous video, it will be called as a loss of cash inflow. I hope you remember that, right? So if this is 100 and this is, let's say, 60, we say that if I go for the new bond, 100 rupees savings I get. If I continue existing bond, 60 rupees savings I would have got. So by replacement, the incremental savings are 40. It is a cash inflow. But children, if this is 100 and this is 160, then I'm very sure you understand that if I go for the new bond, I will get a savings of only 100. If I would have continued the existing bond, I would have got a savings of 160. So by replacing, I am losing 60. I hope you understand. So what we have to do now, we will have to make a working note, children. We will have to make a working note to first of all calculate these tax savings, right? To calculate these tax savings on both the bonds and then understand whether it's a savings, which means an incremental saving, or it's a loss of savings due to replacement. Can we start? So for that, we will have to make a note. So children, I will now make a note for you. Please pay attention. Very important note. I'm writing here note 1. Okay, so in note 1 I'm writing here new bond. Please be very attentive. New bond, children. In the new bond, what are the flotation cost? The flotation cost, as we know, is 6 million, right? The flotation cost is 6 million. Now children, if you know that the flotation cost is 6 million, tell me, the 6 million you're incurring one shot today, but will you get the tax savings also one shot today? No, you'll get a tax savings on the amortized flotation cost. So children, do you realize? I'll write down, therefore amortized flotation cost over the next 6 years will be 6 million divided by 6 years, that is 1 million, which means every year 1 million we will amortize, and on this 1 million every year we will be able to save tax. So I'll write down, therefore tax saved. Okay, tax saved will be 1 million into the tax rate. The tax rate, as we know, is 30%. So 0.3 million per annum is what we will be saving if I go for the new bond, due to the amortization of flotation cost being an allowable expense in the amortized form. Everybody following till here? Now children, what we'll do is we will write down here point number B, existing bond. Children, I want you all to be extremely attentive. Okay, existing bond. Now if I continue my existing bond, I will anyways be getting a tax savings on amortized flotation cost, because I still have an unamortized flotation cost pending to be amortized in the existing bond. I hope you understood. And if you remember, the unamortized part, children, is 9 million. So children, do you realize, in the existing bond, amortized flotation cost is 9 million. This is supposed to be amortized over the next 6 years. So I'll write down, therefore amortized flotation cost will be 9 million divided by 6 years. 9 divided by 6 will give us 1.5 million. Yes, 1.5 million per annum. Children, per annum is the amortized flotation cost, which will happen if we continue the existing bond. Therefore the tax saved, children, the tax saved will be 1.5 million into the tax rate. So 1.5 into 0.3, if we do, we get 0.45 million. Students, 0.45 million is the tax we will save if the existing bond is continued. On the other hand, if I go for the new bond, only 0.3 million tax we will save, which means, I hope you understand, if I continue my existing bond, 0.45 million is a tax we'll save every year. If I go for the new bond, by replacing this, only 0.3 million will be the tax we save. Do you realize, due to replacement, there is a loss in savings of tax? I hope you understood. There is a loss in savings of tax, because 0.3 million cash flow of the new minus 0.45 million cash inflow of the existing will give you a negative cash inflow, which is obviously a loss of cash inflow, right? So children, can I say, therefore loss of tax savings? Okay, loss of tax savings will be 0.3 minus 0.45, that is nothing but 0.15 million. Yes, 0.15 million tax savings we will lose every year. Now children, if you are losing this cash inflow every year, the present value of that will be, I'll write down, therefore present value will be 0.15 million into the PVAF, right? Every year you're losing this PVAF of 7%, 6 years, that is 0.15 million into, children, if you remember, the PVAF we had already taken to be 4.766. So I'll write down here into 4.766 if we do. So 0.15 into 4.766 will give us 0.7149. Yes, 0.7149 million is the present value of the loss of tax savings due to flotation cost, amortized flotation cost. Everybody follow till here? So children, I will go upstairs again and I will write down in PV of CO, obviously. Yes, loss of tax saved. Okay, loss of tax saved on amortized flotation cost. Loss on tax saved on amortized flotation cost, note 1 I will write, and the answer straight away I'll write is 0.7149 million. Yes, 0.7149 million is the present value of the tax savings lost. Everybody clear with this? Students, with that we have completed another cash flow now. Yes, so now what is left are 1 and 2 cash flows. As far as existing bond is concerned, we have knocked off everything. So whatever is left now here will be in itself the incremental cash flow. I hope you understood, right? Students, what I will do is I will now remove all those cash flows from the project details which we have already accounted for, and only what is left I will show on the screens. Okay. Okay students, so I've removed everything. Now what is left is now, first of all, the call premium. Children, call premium is an outflow for us. There is no corresponding cash outflow here, so in itself becomes the incremental cash outflow. And of course, you know, call premium is happening when you of course refund the existing bond today, and that cash outflow will happen today itself, right? So I'll go to PV of CO now. In PV of CO, I will write down call premium. Okay, call premium. Now children, as far as call premium is concerned, they are telling you that the call premium, can you see here, the call premium is 4%. 4% of course on the principal amount of 300 million. So children, I will write down here, yes, I will write down the working here, 300 million. Okay, 300 million into 4%. I hope you understand. 300 million into 4% is the call premium. Children, on this we will be saving tax. So post the tax savings, I will do into 1 minus 0.3. I hope you understood this. And children, since it is happening today, the discounting factor will be 1. Yes, the discounting factor will be 1. So children, 300 into 4% into 0.7 into 1 will give us 8.4 million as the call premium. I'll write down here 8.4 million as an outflow. Everybody followed? Yes. So 300 million into 4%, net of the tax savings happening today, present value is 8.4 million for the call premium. So children, with that we have completed the call premium calculation also. And now what is only left is the last point. Children, I hope you remember that if I go for the new bond today, and therefore refund the existing today, whatever unamortized flotation cost is there in the existing bond today, that one shot will be recognized as a tax cash inflow, tax savings for us, right? So children, tax saved on unamortized flotation cost. Children, the unamortized flotation cost was 9 million. So if I go for the new bond today, entire 9 million will be recognized today only, because the existing bond on which this unamortized flotation cost was there will cease to exist. The entire tax savings will recognize today only. So children, on 9 million I will show in PV of CI. Please pay attention. I will write down here tax saved. Okay, tax saved on unamortized flotation cost of existing bond. Okay, tax saved on unamortized flotation cost of existing bond. I hope you people understand it is nothing but 9 million. Entire 9 million will recognize today only into the tax rate. Tax rate is 30%, right? Students, I hope you realize I am not here calculating post-tax flotation cost. No, I am calculating the tax saved by flotation cost. Therefore, I am not multiplying by 1 minus 0.3. I am straight away multiplying by 0.3. So 9 million into 0.3. Of course, I'll multiply by 1 because it is happening today. So children, 9 into 0.3, if we do 2.7, yeah, 2.7 will be the tax saved present value. Everybody followed? So children, with that we have completed all cash flows. Now there is nothing left. Let us do the calculations of the incremental cash flow. Can we start? So children, 300 plus 20.0172 plus 2.7, yes, minus 300 minus 6 minus 0.7149 minus 8.4. If we do, we get 7.6023. We'll round it off to 7.60 million. Incremental NPV at the rate 7%, since it is positive. Since the incremental NPV is positive, what does that mean? That means that the NPV, if the new bond is issued today and the existing bond is refunded today, is more than the NPV if the existing bond is continued, which means what to do? It is worth replacing, replace the bond, refund the existing bond and go for the new bond, since the incremental NPV is positive. Everybody following? So students, I hope you understood a first-hand experience on how to calculate bond refunding question. Children, similar 2 more questions I have. Next question will be quite similar to this question only, but the question after that will be slightly complicated. Don't worry, we'll solve it together. Yes. So thank you very much, students. I'll now flash the solution of this question on your screens. You can pause the video and copy it on the notes. Thank you so much. See you in the next video with a similar question. Hi friends, let's look at question number 44 now. Students, this question I picked up from the old practice manual of portfolio management. It is also there in the old practice manual of security valuation, and it came in the November 2008 paper for 6 marks. Students, I would request everyone to pause the video here and read it and then try it also, because nothing much is there in this question. I am very sure you will be able to do it. Start. Okay children, I hope you tried the question and I'm very sure you got the answer. I'm very sure you even found this question same as the previous question. Not same in a sense, very similar in calculations, okay? So ABC Limited has been maintaining a growth rate of 10% in dividends. This is your G. The company has paid dividend of 3 per share. This is your D, 0. The rate of return on market portfolio is 12%. This is your RM. The risk-free rate of return in the market has been observed at 8%. This is your IRF. The beta of company's share is 1.5. This is your beta. You are required to calculate the expected rate of return on company shares as per CAPM model. See, so much spoon feeding they are doing. Of course, if they would have just asked equilibrium price per share by dividend growth model, for that anyways I had to find KE. Anyways, they asked us and they're giving us 6 marks for it instead of 5. So good, let's do it. So right now, students, tell me what is the first thing I'll find? I'll find KE. Then I will go on to find the value of equity. So can we start? I'll write down now here question number 44. Okay, point number 1, calculation of KE. Okay, point number 1, calculation of KE. What is the formula, students, of KE? Very simple. IRF plus RM minus IRF into beta. IRF plus RM minus IRF into beta. Students, what is IRF here? IRF, do you see, is 8%. Risk-free rate of return is 8%. RM is 12%, correct? So IRF is 8, RM is 12 and beta is 1.5. So I will write down here 8 plus 12 minus 8 into 1.5. So 12 minus 8 into 1.5 plus 8 will give you a 14% as your KE. Next, students, point number 2, calculation of value of equity. For that, first of all, I'll have to find D1. D1, do you realize, will be D0 plus the growth rate, that is 3 plus 10%. Yes, so I'll write here 3 plus 10%, which is equal to rupees 3.3. Next, let's put the formula. V bracket E is equal to D1 upon KE minus G, that is 3.3 upon, what is the KE, students? You already got the KE as 14%. So I'll write down here 14% minus growth rate is 10%. So this is nothing but 3.3 divided by 4%. And if you take the calculus, 3.3 divided by 4%, you get rupees 82.5. Rupees 82.5. Students, I'm very sure you got the same answer, rupees 82.5. Thank you so much, students, for understanding this question, question number 44. So see you in the next video with another question on this concept. Now you can pause the video and copy the notes that are flashed on your screens. Thank you so much. Hello friends, let's now do another question on portfolio beta. Question 63 from the old practice manual. I've taken this question. So let's start, students. I would request everyone to pause the video here and read the question carefully. Okay students, I hope you all have read the question. Let's now start trying to understand it. A Limited has an expected return of 22%. Okay, A Limited has an expected return of 22% and standard deviation of 40%. B Limited has an expected return of 24% and standard deviation of 38%. A Limited has a beta of 0.86, B Limited has a beta of 1.24. The correlation coefficient between the returns of A and B Limited is 0.72. The standard deviation of the market return is 20%. Sigma M is given to you. Suggest, point number 1, is investing in B Limited better than investing in A Limited? Students, this is your basic Markowitz understanding. Look at it. A Limited, A bar is 22, sigma A is 40. B limited, B bar is 24, sigma B is 38. Can you see, as far as the returns are concerned, B is offering higher return as compared to A. As far as risks are concerned, B's risk is lower than that of A, which means B dominates A. B is more efficient than A. We should go for B. Yes, investing in B is better than investing in A. I hope you understood this particular point. In the notes, which will be flashed at the end, I will give you the note for this point number 1, correct? Let's go ahead. Point number 2. Okay. If you invest 30% in B limited and 70% in A limited, which means between A and B the ratio is 70-30, what is your expected rate of return and portfolio standard deviation? Which means they're asking you RP and sigma P, portfolio return and portfolio standard deviation. That we will have to solve now. Can we start? Students, let's start. What is the formula of RP? RP formula, obviously you know, WARA plus WBRB, correct? WARA plus WBRB. Students, the weight of A is 0.7 and the weight of B is 0.3. And RA and RB, students, can you see A's expected return is 22 and B's expected return is 24. So let's start. So I'll write down here into 22 and into 24. So if I take the calces, it is 0.7 into 22 M plus 0.3 into 24 M plus MRC. I get my RP as 22.6%. Done. Let us now go on to understand sigma P. Students, sigma P formula will be what? WA square sigma A square plus WB square sigma B square plus 2 into WA into WB into sigma A into sigma B into RAB, the whole under root. Let's put the weights first. We know the weight of A is 0.7 and weight of B is 0.3. So under root 0.7 square into sigma A square plus 0.3 square into sigma B square plus 2 into 0.7 into 0.3 into sigma A into sigma B into RAB. Let's take sigma A and sigma B now. So sigma A is 40, sigma B is 38. So sigma A 40, sigma B 38. So I'll write down here 40 square, 38 square, 40, 38, and the last point now is RAB, that is given to us as plus 0.72. So I'll write down here 0.72. So let's start the calculations. 0.7 into equal to into 40 into 40 M plus 0.3 into equal to into 38 into 38 M plus 2 into 0.7 into 0.3 into 40 into 38 into 0.72 M plus MRC and root. I get 37.06% as the sigma P. Okay. So with that we complete our point number 2 as well. Okay. Point number 1 done. Point number 2 done. Now let's go to point number 3. What is the market portfolio's expected rate of return? Which means market's return means they're talking of RM, and how much is the risk-free rate? They're talking of IRF. Students, look at the question. Anything about market is given? Yes, sigma M is given. Apart from that, nothing is available, correct? Students, how do you propose to solve this? What can we do to find RM and IRF? Students, we have the KE formula, correct? We have the KE formula in which RM and IRF comes, right? So let me write it down for both the securities. KE for security A should be IRF plus RM minus IRF into beta of security A. Students, beta of security A is given to us as 0.86. So I'll write down here 0.86. And KE for security B, students, I will write IRF plus RM minus IRF into, what is the beta of security B? It is 1.24. Yes, it is 1.24. So let me write it down there, 1.24. Okay, students, now how do I get out of this jinx? Please think hard. Do you realize the only two variables you need is RM and IRF? If somehow I have the K's A and B, then do you realize I will have K, I'll have the beta, the only two variables unknown will be RM and IRF, but I have got two equations also, I can simultaneously solve them and get RM and IRF. So the whole thing now is to find K. Students, we have no option here, they have not given us K here, and we do not even have the data to calculate K. So what we'll have to do, we will have to assume that A and B lie on the SML. I'll again repeat, A and B lie on the SML, which means A bar and B bar is equal to KE. Because unless I assume this question, I cannot go ahead. Okay, so here we assume that the A bar of A is the KE of A and B bar of B is the KE of B. 22 and 24. Can we start? So students, let's start now. Therefore, 22 is equal to IRF plus RM minus IRF into 0.86. 24 is equal to IRF plus RM minus IRF into 1.24. Okay. Now students, let's say this is equation 1. This is, let's say, equation 2. Let's do 2 minus 1. Ready? Simultaneously we'll solve them. So 24 is equal to IRF plus RM minus IRF into 1.24 minus 22 is equal to IRF plus RM minus IRF into 0.86. So if we solve this simultaneously, 24 minus 22 is 2. IRF gets cancelled. What will be left is RM minus IRF into 1.24 minus 0.86 comes to 0.38. Yes, 0.38. Therefore, can I say RM minus IRF is equal to 2 upon 0.38. So I do 2 divided by 0.38. I get 5.26. I get 5.26. Okay students, now that we have got RM minus IRF as 5.26, let us substitute this in any equation. Let us substitute it in equation 2, for example. I'll write down here. Therefore, equation 2, 24 is equal to IRF plus. Instead of RM minus IRF, I will take 5.26 into 1.24. 5.26 into 1.24. Therefore, 24 is equal to IRF plus. Students, 5.26 into 1.24 if you do, I will get 6.5224. So therefore, students, my IRF will be equal to 24 minus 6.5224, which comes to 17.48%. 17.48%. If I substitute this in RM minus IRF equal to 5.26, RM minus 17.48 is equal to 5.26. Therefore, RM will be 5.26 plus 17.48, that comes to 22.74%. So students, with this we get the IRF, we get the RM. Yes, students, this can also alternatively be solved using the ERR formula. ERR formula, very simple. If you know what is the formula of ERR, I will show it to you here only. See, if the two securities are lying on the SML, then ERR of A should be equal to ERR of B. You remember this? Okay, what is the K? What is the RX of A here? RX of A here is 22 minus IRF is what we are searching, divided by beta of A, that is 0.86, should be equal to 24 is the return of B minus IRF divided by 1.24, the beta of B. Let's now solve this. 1.24 into 22 minus IRF is equal to 0.86 into 24 minus IRF. So students, now 1.24 into 22 if we do, we get 27.28 minus 1.24 IRF is equal to 0.86 into 24, which is 20.64 minus 0.86 IRF. Yes. So now students, let's take the IRFs together. So I will now write 27.28 minus 20.64 is equal to 1.24 IRF minus 0.86 IRF. So let's take the calci. 27.28 minus 20.64 will give me 6.64 is equal to 1.24 minus 0.86, that is equal to 0.38 IRF. Therefore, my IRF, students, will be 6.64 divided by 0.38. So 6.64 divided by 0.38 will give me 17.47%. We had also got 17.48, that 0.01 is a rounding of difference. Okay, so students, now that IRF is available, you can substitute this IRF in any KE formula, whether for A or for B. You have the KE now, you have the IRF now, you have the beta now. RM can be found as a balancing figure. Okay, not a big deal. I just showed you another alternate solution to find this. I solved it using simultaneous equations. Okay, so with this, point number 3 is over, where they asked us to find market's expected rate of return and risk-free rate. And now the last point, point number 4, which is why this question is there in this module. What is the beta of portfolio if A's weight is 70 and B's weight is 30? Okay, A's weight is 70 and B's weight is 30. So they're asking us to find beta P with these weights of A and B, 0.7 and 0.3. Can we start? So students, point number 4 now. Okay, beta P is equal to WA beta A plus WB beta B. Students, weight of A is 0.7, weight of B is 0.3. Beta A, we by now know it, 0.86, and beta B is 1.24. Let's take the calculators. 0.7 into 0.86 M plus 0.3 into 1.24 M plus MRC, we will get the beta of the portfolio as 0.974 times. 0.974 times. Okay, so with this, students, we complete this question number 63. Thank you very much. I will now flash the solution on the screen so you can copy it down in your notebooks. See you in the next video with another sum on portfolio beta. Thank you so much. Hello friends, let us now do question 26. I request everyone to please pause the video and read the question carefully. Start. Okay friends, I hope you all read the question. See, so many places. Very important question. Okay, let's start. So, on 1/4/2012, ABC Mutual Fund issued 20 lakh units at rupees 10 per unit. Relevant initial expenses involved were rupees 12 lakhs. Okay. Next, they are saying it invested the fund so raised in capital market instruments to build a portfolio of 185 lakhs. During the month of April 2012, it disposed of some of the instruments costing 60 lakhs for 63 lakhs and used the proceeds in purchasing securities for rupees 56 lakhs. Fund management expenses for the month of April 2012 was 8 lakhs, of which 10% was in arrears. In April 2012, the fund earned dividends amounting to rupees 2 lakhs and it distributed 80% of the realized earnings. On 30/4/2012, the market value of the portfolio was 198 lakhs. Mr. Akash, an investor, subscribed to 100 units on 1/4/2012, disposed of the same at closing NAV on 30/4/2012. What was his annual rate of earning? Can we start? So students, what they are saying, there is a Mr. Akash. He purchased 100 units on 1/4/2012 and he disposed of the same at closing NAV on 30/4/2012. Can you see? He has been holding this mutual fund for a period of only 1 month, but they're asking you the annual return. So we'll calculate his monthly return and then multiply the same by 12 to find the annualized return. Everybody following? But now to find the monthly return also, do you realize we will need to calculate the closing NAV as on this date plus the dividends he received, etc. All that calculations is necessary to be done. So students, our most important point now is to calculate the NAV on the closing of this month, that is 30th of April 2012. Can we start? So let's start reading now. Students, they are saying on 1/4/2012 it was the opening of this mutual fund, which means this mutual fund opened at NAV of 10, correct? And then we have to now find what will be the NAV on the 30th of April, which means when Akash purchased this mutual fund, do you realize that he has been able to purchase a unit of mutual fund for rupees 10, and then let's see how much dividends he gets. Let's see how much he gets when he closes off his position by selling off the mutual fund units at the NAV of year 1, for which the most important calculation is the NAV of year 1. Everybody following? Let's start. Students, this question actually is a calculation of returns from mutual fund question, because for Akash, they've asked you to calculate the return of mutual fund, but I have not kept it on purpose in the returns on mutual fund module, because students, in this more important than the returns is the calculation of NAV, correct? Hence I've put it here. Calculations of returns you anyways know, right? NAV1 minus NAV0 plus D1 the whole upon NAV0 into 100, that you anyways know. We have to just now find out the NAV, correct? So let's now start. So they are saying ABC mutual fund issued 20 lakh units at rupees 10 each, and lot of things are happening. Students, do you realize our first goal would be to calculate the cash balance, correct? Closing cash balance. And once we get the closing cash balance, we'll put it in the NAV to find out the final NAV per unit. Ready? So students, the first impact on cash, can I say, is to raise 20 lakh units at 10 rupees per unit, which means 200 lakh rupees cash or bank basically came in. Everybody following? So students, question 26, first things first, calculation of cash balance, particulars and amount, subscriptions received. I hope you understood 200 lakhs you are receiving subscriptions. Next, they are saying relevant initial expenses were 12 lakhs. That will obviously be subtracted, less initial expenses 12 lakhs. Then they are saying that they are investing the funds so raised in capital market instruments to build a portfolio of 185 lakhs, which means students, from the money you raised, 185 lakhs, can I say, you paid to build your portfolio. So as far as cash is concerned, do you realize less investment in capital markets, 185 lakhs will now go out, correct? It will reduce from your existing cash balance. Yes, let's now read ahead. During the month of April, it disposed of some of the instruments costing 60 lakhs for 63 lakhs, which means they sold investments costing 60 for 63. Do you realize as far as cash balance is concerned, the relevant amount will be only 63 lakhs, correct? So I was able to sell investments worth 63 lakhs, so 63 lakh rupees cash will come in. So I'll write down here, add sale of investment 63 lakhs, correct? Then they are saying, and use the proceeds, use this amount to purchase another few securities for 56 lakhs. This will again reduce your cash bank balance. So less investment in securities, 56 lakhs. Yes. Next, let's read ahead. Fund management expenses for the month of April was 8 lakh, of which 10% was in arrears. That means from 8 lakhs, can I say, and 90% is what you have already paid. So 8 lakh into 90%, children, is nothing but 7 lakh 20,000, correct? So therefore I'll write down here, less fund management expenses paid, that is nothing but 8 lakhs, minus 10%. Why am I doing minus 10%? Because the 10% has not yet been paid, it is accrued. It will of course be shown in the NAV calculations, less fund management expenses accrued, but as far as cash balance is concerned, only 7.2 lakhs. That is 90% of 8 lakhs will be shown. It will be subtracted from the cash balance, correct? Because that is actually what is paid already. Let's read ahead. In April 2012, the fund earned dividends amounting to 2 lakhs. So another cash inflow, correct? Dividends earned, add dividends earned, 2 lakhs. Everybody following? Next, they are saying, and it distributed 80% of its realized earnings. So if it is distributing its earnings, can I say cash will reduce? So students, as far as that is concerned, less realized earnings distributed, note 1. So before I show you the note 1, tell me what all will come. They are saying whatever earnings you realized, you are distributing. Children, do you realize there are two types of earnings you are realizing here? See, first of all, can I say 60 lakh cost of securities you are selling for 63 lakhs, which means the realized earnings here are 3 lakhs of capital gain. Apart from that, can I say, students, this particular mutual fund is earning dividends of 2 lakhs. So 2 lakhs dividends it is earning. Total it is earning 5 lakhs. So the realized earnings are 5 lakhs. 3 lakhs of capital gain, 60 lakhs worth costing assets are sold for 63 lakhs. 3 lakhs is the capital gain. 2 lakhs other sources, dividends you earned as a mutual fund. Total what you are earning are, students, is rupees 5 lakhs. And then they are saying whatever you net realize, see, these are not only earnings, these are realized earnings already in your hand. So they are saying that we are going to distribute 80% of the realized earnings to the unit holders, which means 5 lakhs into 80%, that is 4 lakh students cash will be distributed to whom? To the existing unit holders. So therefore I write down here 4 lakhs. I have shown a note also how that 4 lakhs came. Calculation of distribution of realized earnings, 63 lakh minus 60 lakhs is 3 lakhs plus 2 lakhs, 5 lakhs, the whole into 80%, 4 lakhs. Everybody followed this note 1. So students, that 4 lakhs we pay off. Anything else is given in this question regarding the NAV? Nothing else, correct? All this other data will form part of my NAV calculation, right? Final. Let's now read ahead. Anything else given to you students regarding the cash balance? Students, regarding the cash balance, nothing else is given to us. All this data will form part of my NAV calculations, yes. So as far as cash is concerned, students, we have taken everything into consideration. So let us now calculate the closing cash balance. If we take everything into consideration, my final closing cash balance is 0.8 lakhs. Everybody following? 0.8 lakhs becomes my closing cash balance, which will of course be forming part of my NAV calculations. So in NAV, my closing value of cash 0.8 lakhs. Everybody following? Also, I'm very sure you understand outstanding fund management expenses. As I told you earlier, 10% was outstanding of 8 lakhs. So 0.8 lakh students is an outstanding payable. And as far as the shares you own at the end of the month of April, they are saying that the value of the shares, the market value of the portfolio was 198 lakhs. So straight away I will write down value of portfolio 198 lakhs, which means as on 30th of April, I am owning shares with a market value of 198 lakhs. We have cash balance closing of 0.8 lakhs. There is an outstanding fund management expense to be paid 0.8 lakhs. So do you realize my closing value, net assets closing value will be 198 lakhs plus 0.8 minus 0.8, that is 198 lakhs. And students, they are saying that they have distributed 20 lakhs. And then we do divide by number of units, students, and we know the number of units. We had issued how many number of units? 20 lakh number of units. So therefore students, here I divide this 198 lakhs divided by 20 lakhs, I get my closing NAV1 as 9.9 rupees, correct? This lakh won't come, by mistake I've written here, this is 9.9 rupees. Lakh and lakh will obviously get cancelled, right? So closing NAV, students, is 9.9 rupees. Everybody clear with this? Yes. So students, with that we have not yet finished the question, okay? Only final NAV we got. What are they asking in the question? They are saying that if there is a Mr. Akash who has bought 100 units at the rate 10 at the outset, and now if he sells all the units, what will be his annual rate of return? Students, he is going to sell the units in a month's time, correct? So whatever return we'll get for him will be monthly return, correct? Tell me students, how many units he has? 100 units, which means for Akash, the investment value must be 100 into 10, that is 1000 rupees, correct? And then when he sells off his portfolio, 100 units he will sell off. Students, 100 units he will sell off obviously at 9.9 rupees per NAV. So 100 into 10, correct, is the investment value. 100 into 9.9 children is what he will be able to sell the units for. In the interim, can I say, he is also going to get dividends. Students, how much is the distribution of cash? 4 lakh. This 4 lakh cash, students, do you realize will be distributed amongst 20 lakh unit holders, and Mr. Akash is only owning 100 units. So therefore, accordingly, he will be also getting some cash proportionately. Everybody following? 4 lakh was what the cash was distributed amongst 20 lakh units. So we do this calculation, we'll get the amount of cash dividends, earnings that he will receive from the mutual fund, correct? So let's start, students. Calculation of return for Akash. Students, his investment today is 100 units into 10, that is rupees 1000. Dividends received D1. Yes, 4 lakh total distributions divided by 20 lakh units. We are holding only 100 units. That means 20 rupees is what the dividends will be getting. And then they say the end value NAV 9.9, students, is what the NAV we already have at the end of April month. 100 units when we sell, we will get a value of 990, correct? So the return for this guy will be, he is selling at 990 minus his investment at 1000, correct? Plus the earnings that he gets in form of cash dividends 20. Dividends and the capital gains both are there in this 20 divided by P0, NAV0 into 100 will give me 1% return. Students, 1% return is the return for Akash for an effective period of 1 month. On an annualized basis, students, it is nothing but multiply by 12. We will get 12% per annum, children, as the return of this mutual fund for Akash 12% per annum. For him, effectively for 1 month, it is only 1%. Everybody following? So students, with that we complete question 26 also. I hope you understood this question, children. Thank you very much. I'll now flash the solution of this question on your screens. You can pause the video and copy down the solution. See you in the next video. Thank you so much. Hi friends, so welcome to one more question, that is question 70. Students, this question is also based on that same concept of riskless hedging portfolio model. I request everyone to please pause the video and read the question once. Please start. Okay students, I hope you all read the question. Let us read it together. Mr. Dayal is interested in purchasing equity shares of ABC Limited, which are currently selling at rupees 600 each, S0. He expects that price of share may go up to 780 or may go down to 480 in 3 months. The chances of occurring such variations are 60% or 40% respectively, which means upside probability given as 0.6, that is 60%, and downside is 40%. A call option on the shares of ABC Limited can be exercised at the end of 3 months with a strike price of 630. This is your K. Everybody following till here? What combination of share and option should Mr. Dayal select if he wants a perfect hedge? What should be the value of the option today? Risk-free rate is 10%. Students, isn't it very similar to the immediate previous question we did? And therefore, considering the fact that you know me and you have been studying SFM from me from so long, I'm very sure you understand me by now, and you therefore should understand that I'm going to give you this question as a test. Okay, point number 1 and 2 will be a test. Point number 3 is also a test. I'll just explain to you what is to be done. They're saying what is the expected rate of return on the option. Okay, so that is what they're asking you. Students, very simple. I'll tell you what the institute has done. Point number 3 I will show you. See, can I say during the course of your solution, you will obviously be getting C1U as some value. You will obviously be getting C1D as some value, correct? And at the end, you will obviously be getting C0 also. That is the final answer of point number 2, correct? This is the value of C0 you will be getting here. Now, children, what institute has done is, they are saying that we have already given to you the probabilities as 60% and 40% of up and down. Everybody following? Up and down probabilities are given as 60% and 40%. So I'll write down here PU is 0.6, PD is 0.4. This is the institute solution. Please pay attention. Can I say C1U is available, C1D is available, PU is available, PD is available? We can easily find average. Okay, average C1, can I say, will be C1U into PU plus C1D into PD. I hope you understand, correct? C1U into 0.6 plus C1D into 0.4. And with this formula, students, you can easily find the weighted average C1. Now, what institute has done is, it is asking you in point number 3, what is the expected rate of return on the option? It says the rate of return on that option is nothing but C1 that we got here minus C0 we got here in point number 2, the whole upon C0 into 100. Okay, C1 minus C0, the whole upon C0 into 100 will give you the return on the option in case you buy the option at C0 and sell it off at C1. I'm very sure you understand this is the formula for a normal return on any investment, correct? So C1 minus C0, the whole upon C0 into 100 is the rate of return on this option. How do we get C1? It's a weighted average C1 of C1U and C1D with the weights given to you, the probabilities given to you as 0.6 and 0.4. C0, students, must have been calculated by you in point 2. So all numbers you have, students, I am giving point number 3 also as a test to you. Okay, so students, this is a test now, question number 70. I am now asking you to immediately pause the video and start the test. Only and only once your solution is ready, then play the video. I will be flashing the solution on your screen, so you can pause the video and tally your answers with mine. Okay, your time for the test starts now. Pause the video and start the test. Okay, students, I'm very sure you're ready with the solution of question 70. I'll now flash the solution on your screens. You can pause the video and check your answers with mine. I am having confidence on you that your answers will be right. In case 1 or 2 mistakes you have done, please check every number, okay? In case some error you have done, please note it down and don't repeat that mistake again, okay? So thank you very much, students. With this, we end this question 70. See you in the next video with another question. Here is the solution. Tally your answers. Hi friends, welcome to this video where we will be discussing one more question based on this concept of cross hedging with index futures. I request everyone to first of all pause the video and read the question carefully. Start. Okay friends, I hope you all read the question. Let us now try to understand this. They are saying Ram buys 10,000 shares of X Limited at a price of rupees 22 per share. So students, can I say that Mr. Ram here has gone long on, okay, he has gone long on how many shares? 10,000 shares of rupees 22. So I'll write here 10,000 shares of rupees 22, which means children, do you realize the value of the asset that Mr. Ram is long on is worth rupees 2,20,000? Everybody clear till here? Then they are saying the beta of this asset, this share, that is X Limited share, is 1.5. So I'll write here beta is 1.5, right? Next, now this part I will read in some time. I'll go ahead now. He obtains a complete hedge by Nifty futures at rupees 1000. So basically, do you realize here that the value of a futures contract is rupees 1000. So here they have not given to you the bifurcation between the points and the multiplier. Straight away they have multiplied the number of points by the multiplier and given to you the value of the futures in rupees terms only, right? So this is the value of the futures contract. Can I say value of the asset? Just now we had got as 2,20,000. So do you realize, since we have gone long in the cash market, to hedge this we will have to go short in the derivatives market. Everyone clear? So I'll write here, therefore number of futures contracts to sell. Everyone clear? Number of future contracts to sell would be, what is the formula I taught you? Beta into VA upon VF. Everyone clear? Beta into VA upon VF, where your beta, children, here you can see your beta is 1.5 and the value of the asset, as you can see here, is 2,20,000 and value of one futures contract is rupees 1000. So we'll take the calculator here, 2,20,000 multiplied by 1.5 divided by 1000, and this comes to 330 contracts. So children, in order to hedge our position, we will have to sell 330 futures contracts, these index future contracts. Now what is Mr. Ram doing? He's saying apart from buying shares, he is also going to be short selling shares of some another company, that is A Limited. He's saying he's going to short sell 5,000 shares at a price of rupees 40. So now all this was as far as X Limited was concerned. Now as far as A Limited is concerned, can I say he's going short on A Limited shares? How many shares? This is 5,000 shares of rupees 40. So I'll write here 5,000 shares of rupees 40. So do you realize that the value of the asset here on which he is going short will be rupees 2 lakhs? Everyone clear? Value of the futures contract, of course, will continue to remain 1000. We are using the same Nifty futures contract. And students, do you realize that the beta of this A Limited is 2? So I'll write here beta is 2 times, right? So you tell me now, if I want to hedge this position, what should I do? I should go long on futures or I should go short on futures? I should definitely go long on futures. I should buy futures since I have a short position in the cash market. So I'll write here number of futures contracts to buy, okay, number of futures contracts to buy would be 2 into, that is beta into value of asset divided by value of futures contracts, and if you solve this you will get the answer as 400 contracts to buy, right? So therefore, do you realize, if you see the end-to-end result of our entire portfolio, where on one side we have purchased shares of X Limited, on another side we have short sold shares of A Limited, do you realize to hedge this we will have to, okay, sell 330 contracts of Nifty and buy 400 contracts of Nifty futures. Students, I hope you all understood. Net effect is I can simply buy 70 contracts of Nifty futures. Everybody understood? On one side I am saying that okay, you sell 330 contracts, on another side I am saying you buy 400 contracts, net you buy 70 contracts. So I'll write down here, therefore net number of Nifty future contracts to buy, okay, would be 400 contracts we had to buy, 330 contracts we had to sell, so net we have to buy 70 contracts. Everyone clear? This 70 contracts net will take care of the entire position, both the long and the short position in our cash market. Everyone following till here? Let's move ahead. Of course children, I hope you realize you can go ahead with the 400 contracts buy and 330 contracts sell. Your eventual answer will be same only, right? Okay, now let's move on. So what are they asking you? He closes out his position on the closing price of the next day when all this has happened, and of course now they are asking you what will be the gain or loss. Everybody clear? What will be the gain or loss here for Mr. Ram? Are you ready? Let's try understanding the gain or loss. Students, first of all, I would like to tell you calculation of rupee outflow today. Okay, so today what all rupee outflow Mr. Ram is doing? First of all, do you realize he is buying 10,000 shares at rupees 22? So I'll write here 10,000 shares into 22. This is his outflow. Now students, do you also realize he is short selling 5,000 shares at rupees 40? Correct? Short selling 5,000 shares at rupees 40. So I'll write here add 5,000 shares, okay, into 40. Now students, if you see, this is 2,20,000 outflow and this is 2 lakh inflow. Okay, so do you realize his net outflow today would be rupees 20,000? Everybody clear? His net outflow today would be rupees 20,000. Now this outflow, students, I hope you realize is the outflow in the cash market, right? In the derivatives market is simply taking a position, so there won't result in any kind of outflow here. Of course there would be margins etc, but that is not mentioned in this question. Then children, we come to the due date, that is the next day, the following day. So calculation of rupee inflow, okay, after 1 day, okay, that is on closeout. Now let's understand this. First of all, in the cash market, do you realize he has purchased X limited shares? How many shares he has purchased? 10,000 shares he has purchased. Can I say that he will go and sell? Now if you see, yes, here when he closes out his position, the shares of X limited have dropped by 2%, which means right now it is 22 rupees. In 1 day it will drop by 2%. So do you realize that on sale of X limited shares, Mr. Ram will get, okay, 10,000 shares he will sell at 22 minus 2%. Everybody clear? 22 minus 2%. So on the calci, I'll take 22 minus 2% and multiply by 10,000. He will get 2,15,600, right? He will get 2,15,600 on the sale of X limited shares. Now as far as A limited shares are concerned, he had short sold them. To close out that position, he'll have to buy A limited shares. So I'll write here purchase of A limited shares. Now how many shares had he short sold? 5,000. So 5,000 shares he will have to buy back. The price of the shares when he had sold them was rupees 40, but now they have appreciated by 3%. So I'll write here into 40 plus 3%. Everybody clear? 40 plus 3%. So and that results to, so 40 plus 3% into 5,000. Okay, so that results in an outflow of 2,06,000. okay, 2,06,000. This is the price he will have to pay on the due date, that is the next date basically, in order to purchase back the shares of A limited. Now students, apart from this, I hope you realize he will also close out his futures position, right? So I'll write here profit or loss on close out of futures position, okay, Nifty futures position. Now students, tell me how many contracts he had taken a position on. He had purchased 70 contracts. I hope you remember, he had purchased 70 contracts net. So 70 contracts he had purchased. I hope you realize he had purchased those 70 contracts at rupees 1,000 each. Everybody agreeing? He had purchased 70 contracts at rupees 1,000 each, and on due date he will have to close out the position by selling these contracts. Everybody clear? Taking an opposite stand, he will have to sell these contracts, and when he's selling it, that is the next day, I hope you realize the Nifty futures have dropped by 1.5%. Okay, Nifty futures have dropped by 1.5%. So students, do you realize 70 contracts into 1000, okay, was the buying price, and 70 contracts into 1000 minus 1.5%, okay, minus 1.5% will be the sale price for the closeout. Okay, everybody clear? This is buy and this is sale for closeout. Everybody clear? Yes, this is the original position, right? So the original position was to buy 70 contracts at rupees 1000. To close out, he will sell 70 contracts at 1000 minus 1.5%. 1000 minus 1.5% is 985. So basically 70 contracts into 985 will be the sale value for closeout. So tell me, it is a gain or a loss? Of course it's a loss. I hope you realize the loss will be 70 contracts into the sale value, children, is 985, the buy value is 1000. So if you check here, 985 minus 1000 into 70, there is a loss of 1050. Everybody clear? There is a loss of 1050. So students, do you realize that the final payout on due date would be, okay, so he is selling X Limited shares at 2,15,600, that is an inflow for him, 215,600. Then he is buying A Limited shares at 2,06,000, right? I'll write here 2,06,000, and also there is a loss of another 1050. So if we calculate the final payoff, 215,600 minus 2,06,000 minus 1050, you can see the final payoff is 8550. Okay, 8550. This is what he will get at the end. Now you tell me, how much had he invested at the start? Today he had invested 20,000 rupees today, and at the next day he is receiving back net only 8550. So can I say overall loss, okay, to Ram would be 20,000 is his outflow, 8550, okay, 8550 will be the inflow he will be getting. So 20,000 minus 8550, the loss to Ram would be 11,450. Everybody clear? So what has happened is, today he entered the cash market, purchased shares of X and short sold shares of A. Net investment he is doing today is rupees 20,000, and to hedge this position, both positions if he wanted to hedge, net we saw that he should buy 70 contracts of Nifty futures of 1000 each. The next day, when he is closing out the entire position, he will sell the shares of X Limited he bought, he will buy the shares of A Limited he short sold yesterday, and he will also close out the position on which he is suffering a loss of 1050. So net inflow he will get at the end of everything is 8550. So yesterday he invested 20,000, today he is getting back net 8550, which means, children, do you realize he is suffering a net loss of 11,450? That is what this question was asking you. Everybody clear? So I hope you all understood this entire video, this entire question. I'll now flash the solution of this video on your screens. You can pause the video and copy down the notes. Thank you so much. We'll see you in the next video. Hi friends, so welcome to one more question, one more video, question number 10. Based on this concept of currency options, students, I request everyone to please pause the video and read the question carefully. Start. Okay students, I hope you all read the question. Let us now try to understand this. Question number 10, what are they saying? A Limited of UK, students, the moment UK you see, you understand that your home currency now in this question is pounds, correct? Has imported some chemical worth $364 897, which means here in this question completely opposite of question 9. In question 9, can I say we were Americans, US dollar was the home currency and therefore pound was the foreign currency. Here we are from UK, we are British, and therefore for us pound is the home currency and dollar is the foreign currency we have imported, which means there is a foreign currency payable in future. Everybody following? So I'll write down here question number 10, foreign currency payable. Okay, question 10, foreign currency payable is dollar 3,64,897. So I'll write down here 3,64,897. Everybody clear with this? Then they say the amount is payable in 6 months time. So I'll write down here payable in 6 months time. Yes. Next, what are they saying? The relevant spot and forward rates are as follows. Children, the spot rates given to you, they are saying that spot rate is $1.5617 1.5673. Of course, it is per pound. So I'll write down here, okay, spot rate. Spot rate given to you is 1 pound equal to dollar. Okay, it is 1.5617. I'll write down here 1.5617 dash. The ask rate is 1.5673. So I'll write down here 1.5673. Everybody clear with this? Then what are they saying ahead? They're saying 6 months forward rate is given to you. So I'm very sure, children, by now you are very well versed of what is happening with you all in this chapter. 6 month forward rate given to you is 1 pound equal to dollar. Children, let's take the numbers. 1.5455. I'll write down here 1.5455 dash. Then they say 1.5609. I'll write down 1.5609. Everybody clear with this? So children, with that we have the spot rates, we have the forward rates. Let's go ahead. The borrowing rates in UK and US are 7% and 6% respectively, and the deposit rates are 5.5 and 4.5 respectively. Looking at this, we understand money market hedging is there also in this question. Then they say currency options are available, under which one option is for pound 12,500. The option premium for pound at a strike price of $1.7 per pound is $0.037 for the call and $0.096 for the put for a 6 months period. Children, as usual, the options option we will analyze at the end. Okay, the company has 3 choices. Of course, forward cover, money market and currency option. Here they didn't give you the do nothing option, okay, which you anyways do. Okay, let's now read ahead. Which alternative is preferable for the company? Children, you understand here we have a foreign currency payable. Therefore, whichever option results in the lowest home currency outflow, we will go for that option, correct? Whichever option gives you lower pound outflow, that is our home currency. Can we go ahead now? So children, let's start. Let us evaluate each option one by one. The first option to evaluate, of course, is the forward cover. So children, I'll write down here evaluation. Okay, evaluation of alternative 1, that is the forward cover. Children, straight away in the question they have given to you the 6 months forward rate, 1 pound equal to dollar. They have given in the question 1.5455. I'll write down here 1.5455 dash. Then they say 1.5609. Okay, I'll write down here 1.5609. Children, tell me how many dollars you want to buy. The question says the dollars you want to buy is 364,897. Okay, so $364,897 we wish to buy. Children, if we wish to buy dollars, bank will therefore sell dollars. The relevant rate will be, of course, ask rate of dollar in terms of pound. 6 months forward. Children, the ask rate of dollar in terms of pound will be $1 equal to pound 1 upon 1.5455. I hope you remember this. Okay, 1 upon bid rate. Yes, 1 upon bid rate will be the ask rate in the other quote. I hope you understand. So $1 equal to pound 1 upon 1.5455 will be the ask rate of dollar. Students, we wish to buy these many dollars. So how many pounds will be required? Do you realize I multiply this by 1 upon 1.5455 on the calculator? calci 364,897 divided by 1.5455 will give us pound 2,36,103. Okay, 2,36,103 pounds, children, according to the calci, will be our final pound outflow as far as option 1, that is forward cover, is concerned. Everybody following? Which means today, if I go for a 6-month forward cover to purchase $364,897, the outflow for us after 6 months will be pound 236,103. Everybody follow until here. So with that, children, we complete alternative 1. Let us now go to alternative 2. Okay, so I'll write down here evaluation of alternative 2, that is of course your money market hedging. Correct? Students, in money market hedging, we all know step 1 is identify. Children, tell me what to identify. We have a foreign currency payable. Correct? We have a foreign currency payable of $364,897. Correct? 364,897 in 6 months time. So I'll write down here 3,64,897 in 6 months time. Correct? Next, students, will be step 2. Step 2 will be to hedge. We have to create a foreign currency receivable of exactly same $364,897 in 6 months time. Correct? You have to create a foreign currency receivable of $364,897 in 6 months time. Step 3. Tell me, children, for creating this foreign currency receivable, we will have to invest in dollars. Correct? So we will have to invest the present value of $364,897 today in USA, and of course the relevant rate will be the deposit rate. Deposit rate of what? Dollar deposit rate. Everybody clear? Because we want to invest, we want to deposit in USA today, so that after 6 months it gives us a maturity value of $364,897. For that, how much should we invest today? Students, the dollar deposit rate is given in the question. They are saying the deposit rates of US is 4.5%. Correct? See, borrowing rate of UK is 7, borrowing rate of US is 6. Then they said deposit rate of UK is 5.5, deposit rate of US is 4.5%. Children, 4.5% per annum. So for 6 months it will be 4.5% into 6 by 12 on the calci. 4.5 divided by 2, that will give us 2.25%. So what to invest today will be 364,897 divided by 1.0225. I hope you're understanding. So 364,897 divided by 1.0225 will give us $3,56,867. $356,867. Children, what are these dollars? These are the dollars you need to invest in USA today at the rate 4.5% per annum for 6 months, so that it will grow to a maturity value of $364,897 after 6 months, so that you can take that and knock off your foreign currency liability or payable in 6 months time. Everybody follow until here. Now the point is, if you need these many dollars after 6 months, for that how much pounds will be required? So students, step 4, yes, step 4 will be to convert. Okay, convert what, children? Convert dollar to pound. Basically, we will have to calculate that if I need these many dollars today, $356,867 today, how many pounds are required? Children, do you realize that we want to buy dollars? Correct? We want to buy dollars at spot. So the relevant rate will be the ask rate of dollar in terms of pound at spot rate. Everybody following? Now the ask rate of dollar in terms of pound spot rate will be, yes, can you see here? 1 pound equal to $1.5617-1.5673. Do you realize at spot the ask rate of dollar will be $1 equal to pound 1 upon 1.5617. Correct? So 1 upon 1.5617, yes, $1 equal to pound 1 upon 1.5617 is the ask rate of dollar in terms of pound today. We wish to purchase how many dollars? $356,867. So $356,867. If we wish to purchase, how many pounds will be required today? It is nothing but $356,867 divided by 1.5617. That will give us pounds 2 228,512. Okay, 228,512. Children, what is this? What is 228,512? 228,512 are the pounds required today, so that you can convert it to $356,867 today, so that you can invest those dollars in USA today, so that it grows to $364,897 in 6 months, and that can be used to knock off the liability. Correct? Now children, as far as home is concerned, do you realize this 228,512 pounds we do not have today, and we will therefore be borrowing the same at UK borrowing rate, correct? Pound borrowing rate. So students, my last step today, step 5, will be borrow. Now children, if I borrow, I'll have to borrow pound 228,512 in UK for 6 months at the rate pound borrowing rate. Now children, the UK or the pound borrowing rate given to us in the question is, borrowing rate in UK is 7% per annum. That is nothing but 3.5% for 6 months. Everybody following? 3.5% for 6 months will be the effective borrowing rate for UK. So therefore children, do you realize I'll be borrowing at the rate 3.5%? Everybody clear? Now the last point as far as money market is concerned, on due date children, you know you will be getting a foreign currency receivable, dollar receivable as a maturity of your investment, exactly 3,64,897. You'll take that and knock off your liability. Foreign currency you are hedged, correct? As far as home is concerned children, do you realize your borrowing of 228,512, correct? 228,512 will grow at the rate 3.5% for a period of 6 months, and therefore the maturity value will be 228,512 plus 3.5%. Students, on the calci, 228,512 plus 3.5% will give us a maturity value of pound 236,510. Okay, pound 236,510 therefore is your final pound outflow after 6 months if you go for the money market hedging option. So students, with that we have completed the first two options, that is forward cover and money market. Last now children, let us go for the currency option. Can we start? Students, now last point, please be very attentive. I'll write down here evaluation. Okay, evaluation of alternative 3. Alternative 3 is the options alternative. Okay, now children, as far as options are concerned, what have they given to us? They have given to us that the K, a strike price, is 1 pound equal to $1.7. okay, I'll write it down here. Yes, the K is 1 pound equal to $1.70, correct? Now if you read ahead, they are saying that for a call option on same strike price, the premium is $0.037. So as far as a call option is concerned, the premium they are saying is $0.037 per pound. As far as the put option is concerned, the premium they are saying is, okay, they're saying for the same strike price, the premium will be $0.096. So I'll write down here $0.096 per pound. Everybody clear? Now the question is, what do we want to hedge? Can I say we wish to hedge the purchase of dollars, correct? We wish to hedge the purchase of dollars. Students, so therefore we would of course like to have a dollar option, that is a dollar call or a dollar put. Children, what is a dollar call? If you buy a dollar call, can I say you are buying a right to buy dollars, correct? You are buying a right to buy dollars. Call gives you a right to buy. If it's a dollar call, it gives you a right to buy dollars. If you buy a dollar call, you are buying a right to buy dollars. Students, on the other hand, if you buy a dollar put, tell me what is happening. If I buy a dollar put, can I say I am buying a right to sell dollars in future? But children, as you know, we have a dollar payable and therefore we wish to buy dollars in future, and therefore we would like to go for a dollar call. Everybody following? You would want to buy or purchase or hold a dollar call. But Let's see what the question has in store for us. They say options are available, all data is given, but the underlying asset for each contract is pound 12,500. Students, this is shattering of our dreams. Do you realize we would have loved had there been a dollar call or dollar option, but here can I say they have given to us a pound option. Can you see underlying asset is pound? So if the underlying asset is pound, do you realize that option is not of dollar but of pound? Everybody clear? So children, tell me, if it's a pound option, a pound call or a pound put, tell me what to do. Students, please pay attention. Can I say this is you? Okay, this is the market. You wish to purchase dollars and therefore pay pounds. I hope you understand my explanation now here. The moment such opposite things come, opposite in a sense, we wanted dollar call, but they have given to us pound options, then we'll have to see things a bit differently. Can I say in the heart of hearts, we know that we wish to buy, correct? We wish to buy dollars and therefore pay pounds. But now children, do you realize since dollar options are not available, we will have to see everything from pounds point of view. Pound becomes the product for us for time being. So children, do you realize we need an outflow of pounds and an inflow of dollars? So instead of saying that we want to buy dollars and therefore pay pounds, we will say we want to sell pounds and therefore receive dollars. Everybody following? The arrow's direction will not change. Students, instead of buying dollars, I'm saying I want to receive dollars. Instead of paying pounds, I'm saying I want to sell pounds. So children, do you realize since I want to hedge this transaction of paying pounds, but in more appropriate terms for this question, for selling pounds. Are you understanding? So since I want to hedge this transaction of wanting to sell pounds and receive dollars, do you realize, considering the fact that pound options are given, we would like to go for which option? We wish to hedge the selling of pounds, right? So we will go for the pound put option. Everybody following? If I go for a pound put, if I buy a pound put, if I hold a pound put, basically I am buying a right to sell pounds and therefore receive dollars. Everybody following? The rate is given for every pound, $1.70. Everybody clear? So children, here do you realize we will buy, okay, we will buy a pound put. We will buy a pound put where the strike price is 1 pound equal to dollar. What is the strike price? 1.70. 1.70. What does this mean, children? That means if I buy 1 pound put, I am purchasing a right to sell those pounds at the rate $1.70. Everybody clear with this? We are purchasing a right to sell these pounds at the rate $1.70. Is the story clear? Let us now go ahead. Yes, so now the most important part to calculate here is the number of contracts. Students, why no number of contracts was seen in the previous questions? Because they are not given to us the lot size, correct? Now suddenly in a currency option question, there is a lot size for the options, and therefore children, since lot size is given, we will have to calculate the number of contracts, correct? So children, do you realize the lot size here, okay? The lot size for every contract is 12,500 pounds, okay? Lot size is 12,500 pounds. Done. We wish to hedge pound selling or dollar buying. Students, as far as arrows are concerned, it is same. It is pound outflow and dollar inflow. But students, do you realize, as far as our reality is concerned, we wish to hedge the dollar buying. As far as this question data is concerned, we will be temporarily talking it as we want to hedge our pound selling, correct? Are you listening to me? Yes, either we see dollar buying to be hedged or we see pound selling to be hedged. Doesn't matter. Students, tell me, we want to hedge dollars buying worth how much? 364,897 given in the question, right? 364,897. Are you there? So children, 364,897 dollars worth we need to hedge. So $364,897 if we wish to hedge, then for that how many pounds equivalent we wish to hedge? That is nothing but pound equivalent. If we check, it is 364,897 divided by 1.70. So 364,897 divided by 1.7, that will give me pounds 214,645. Okay, 214,645. Now the most important part, please pay attention. First, understand this. Do you realize I will go and buy pound puts worth 214,645, correct? 214,645. I go to the market today and I purchase pound puts worth 214,645. What does that mean? That means this is me here, this is the market here. I purchase pound puts, which means I'm purchasing rights to sell pounds. I'm purchasing rights to sell 214,645 pounds. Okay, 214,645 pounds at the rate $1.7 per pound, which means, do you realize the equivalent dollar of course is 364,897 at this strike price, which means I am purchasing a right today to sell 214,645 pounds at the rate $364,897. Everybody understood this, and in the heart of hearts we all know that we do not actually want to sell pounds and therefore receive dollars. We want to buy dollars and therefore pay pounds. And therefore, children, do you realize what we are doing is, end of the day, we are going into a contract to buy dollars 364,897 by paying 214,645 pounds. Everybody clear with this? Now students, in this question there is a twist, because in this question there is a lot size. Yes, there is a lot size in this question. Let us see how that applies. Yes, so now students, as far as the lot size is concerned, they are telling in the question that the lot size, students, is pound 12,500. What does that mean? I'll write down here. Lot size, okay, is pound 12,500, which means one contract, if you go for 12,500 pounds worth contract it is, which means if I buy one put contract on pounds, it means today I buy a right to sell not 1 pound but 12,500 pounds at the rate $1.7 per pound. Everybody following till here? Therefore, number of pound put contracts, okay, number of pound put contracts to buy will be how many? Students, can I say we would have loved to buy pound put contracts worth exactly this amount, because so that we would have been able to get these many dollars, correct? But they are saying, hey, wait, you cannot just take any random number and buy put contracts. You will have to go contract wise, and in each contract there is 12,500 pounds. So students, if we want to hedge total these many pounds sale, or basically we want to go for put contracts on pounds worth these many pounds, and if one contract is worth 12,500 pounds, can I say number of put contracts to go for, pound put contracts to buy will be 214,645, 214,645 divided by 12,500, correct? Divided by 12,500. Everybody following? So on the calci, 214,645 divided by 12,500 will give us 17.17 contracts. But of course, you all know you cannot take 0.17 contracts. So I'll round it off to 17 contracts. Everybody following? So children, what is happening here is we are now forced. See, first of all, where we were forced? We wanted to buy dollar call option, correct? Because we wanted to hedge our future buying of dollars. But they said, sorry, there is no dollar option available, there is a pound option available. So we just changed our mindset. In our mind we were thinking we want to buy dollars and therefore pay pounds, but because the options were on pounds, the whole mindset we changed. We said, okay, basically we want to sell pounds and receive dollars. So first of all, the first force that they did, was go for the pound mindset. We said, okay, no problem, pound mindset, we will go for pound puts because we wish to sell pounds and therefore receive in the mind buy dollars. Everybody following till here? But then they're forcing us further. They're saying, hey, wait, for your $364,897, 214,645 pounds you needed, correct? You needed put contracts worth these many pounds, but sorry, do you realize that each contract is having a lot size of 12,500, and therefore if 12,500 pounds is per contract, the number of contracts we can go for is 17.17 contracts, but because 0.17 contract is not available, we will have to go for 17 contracts. Everybody following till here? So children, do you know what is happening here? Now I am forced to buy 17 put pound contracts, correct? So if this is you, okay, and this is the market, and if you have purchased 17 put contracts, okay, 17 put contracts on pound, you know what has happened? You have purchased a right to sell pounds. Everybody following? Put is a right to sell, correct? If I purchase a put pound contract or a pound put contract, do you realize I have purchased a right to sell? I have purchased a right to sell pounds. Everybody following? I've purchased a right to sell pounds. Now how many pounds? Do you realize I've purchased a right to sell 12,500 pounds, correct, into 17 contracts. 12,500 pounds are in each contract. I have purchased 17 contracts, which means I have purchased a right to sell 12,500 into 17 pounds. At what rate, children? At the rate, the strike rate given in the question is $1.70, which means, children, do you realize I have purchased a right to sell 12,500 into 17 pounds at the rate $12,500 into 17 into 1.70. Everybody following? So students, I'll write down here into 1.70. Clear with this? So now let's see what is happening. This is you, okay, and this is the market. You have purchased rights to sell pounds. How many? 12,500 into 17, that comes to pounds 2,12,500, and in turn you will receive dollars, okay, 12,500 into 17 into $1.7 per pound, that is $3,61,250. Everybody following? So now children, if you see from this contract point of view, please pay attention. If you see from this contract's point of view, you have purchased a right to sell 2,12,500 pounds, and therefore to receive $3,61,250. Everybody following till here? You have purchased a right to sell 2,12,500 pounds and therefore receive $361,250. But in the heart of hearts, can I say, you know that by entering into this transaction, you have entered into a transaction to actually buy $361,250 and therefore pay 2,12,500 pounds. Everybody clear? So children, can I say you wanted to hedge $3,64,897. I hope you remember this number. 364,897 was the total dollars that you wished to buy, correct? You wish to hedge in future. 364,897, students, is what you wanted to buy and therefore hedge. From this, children, due to the options contract, can I say you have not hedged the full, you have hedged only the buying of 361,250. That is the trick in this question, because of the lot size, correct? If the lot size was not there, the question would have got over quite earlier, but because there is a lot size and because you are not allowed for this 0.17 contract, do you realize the hedging that is happening is only for $361,250. Everybody following? So children, I'll write down here $361,250 is what I am hedging. There is a balance, okay? What is the balance, students? It is nothing but 364,897 minus 361,250. 250, that will give us $3,647 are yet to be hedged. Everybody clear? $3,647 are yet to be hedged. And what does ICAI say? ICAI says that you cannot go beyond this in options because, students, I hope you understand. See, if you go for 18 contracts, if you round it off to the other side, if you go for 18 contracts, do you realize this will be 12,500 into 18? That is okay. And therefore, do you realize this amount will be more than 361,250? It will be more than 3,64,897 also. I hope you understand, because for 364,897 the number of contracts was 17.17. If you go for 18 contracts, students, do you realize you will end up purchasing more dollars than what you need, and therefore you will not go for that, correct? Why should you enter into a contract for purchasing so much more? I hope you understand. You wanted to hedge only 364,897 purchase. So by going for 17, you are hedging out of 364,897. 361,250 is hedged now. Now the balance is left still to be hedged, 3,647. ICAI says for the balance of these dollars to be hedged, go for the forward cover. You have no other option. Take a forward cover. Go for a forward cover. What is the period here, students? The period here, of course, is 6 months. So it says straight away go for a 6 months forward cover to purchase the balance dollars in terms of pounds. Everybody clear? So students, what is happening is, as far as options is concerned, do you realize it helps you hedge these many dollars? As far as balanced dollars are concerned, we will have to go for a forward cover. Everybody following? So now let us calculate the final cash flow. Okay, calculation of final payoff, or basically cash outflow in terms of pounds, because can I say for us pounds is the home currency. Now students, I'll write down here base cash flow in options. Okay, base cash flow in options. Students, do you realize in options to hedge these many dollars, can I say the pound outflow will be 212,500? Very simple. It is nothing but 12,500 pounds into 17. So 212,500 pounds, I'll write down here, 212,500 pounds will be my outflow. As far as the balanced dollars are concerned, can I say I will take a forward contract? So I'll write down here cash flow for balance dollars using a forward cover. Children, can I say you'll enter into a forward cover? You'll enter into a 6 month forward cover to purchase dollars at the ask rate of dollars. Students, how many dollars you want to hedge? $3,647. I'll write down here $3,647 into the ask rate of dollars 6 months forward. Students, ask rate of dollars 6 months forward we had already taken into consideration earlier, if you remember. Yes, here can you see $1 equal to pound 1 upon 1.5455 was the ask rate of dollars 6 months forward. So 1 upon 1.5455, yes, 1 upon 1.5455, 1 upon 1.5455 is the ask rate of dollars. So therefore, for purchasing $3,647 in the forward cover, in the 6 month forward cover, how many pounds will be required? It is 3,647 divided by 1.5455. That gives you pounds 2,360. Okay, 2,360 pounds additional will be required. Everybody following till here? Now students, I'm very sure you understand, as far as options are concerned, you have to pay a premium also. So I'll write down here premium paid. Okay, premium paid for options. Students, as far as premium is concerned, tell me, we have a put option, right? Put option on pounds. The premium they are saying, students, is for a put option is $0.096, and this premium, children, I'm very sure you understand, have to pay today. So this premium, if we have to pay today, tell me the premium will be paid in pounds or dollars? Of course dollars, correct, because they are saying it's a pound put option. So if you're going for a pound put option, that means you are purchasing a right to sell pounds, no doubt about it. The premium to be paid, of course, will be in price, that is in dollars, that is 0.096 per pound, correct? $0.096 per pound. So children, do you realize the premium paid will be $0.096 per pound total pounds that we are going for in the put option is 212,500. 212,500. Children, therefore, do you realize 212,500 into 0.096 total dollars in premium, correct, is $20,400. Okay, $20,400 will be your total premium that you have to pay today. But children, do you realize we will require our final answer in pounds denomination, correct? So therefore we will have to convert this. So we will talk to ourselves now. We will say, okay, today I require $20,400. Today I require $20,400. For purchasing these $20,400, how many pounds will be required? The answer is the spot rate, ask rate of dollar, because we want to buy dollar, bank will sell dollar at the ask rate of dollar spot. Children, the ask rate of dollar spot will be, can I say here, can you see 1 pound is equal to dollar? This is the spot rate. Students, we need the ask rate of dollar. Ask rate of dollar will be $1 equal to pound 1 upon 1.5617. Everybody following? So the ask rate of dollar in terms of pound in spot is $1 equal to pound 1 upon 1.5617. So children, do you realize $20,400 if I want to buy today, the ask rate is into 1 upon 1.5617. Students, that will give us the equivalent pounds required today for paying the premium. Everybody clear? So on the calci, 20,400 divided by 1.5617, if we do, we will get pounds 13,063. Okay, 13,063 total pounds are required for paying the premium. Everybody clear? So what all is happening? In the options alternative, our outflow of pound is 212,500. For that, we are paying a premium today of 13,063. And students, for the balance hedging of dollars, we are going for a forward contract. 2,360 pounds will go there. Let us calculate the total. Children, this answer is given by the institute, but students, according to me, that answer is slightly incorrect. The reason being, the institute has ignored the interest on premium. I hope you remember, correct? This is on due date, this is on due date, but this is today. So therefore, to compare, we will have to take the interest. Of course, the institute has now put a note below. They are clearly saying that alternatively, you can also include the interest on premium. Children, to keep uniformity, I will definitely be taking the interest on premium. Students, tell me how much interest will be there. I'll write down here only. Now please pay attention. I'll write down interest on premium. Okay, interest on premium. Children, we are paying a premium of pound 2,360. Today we will have to therefore calculate the borrowing rate, correct? The pound or the UK borrowing rate, because we'll assume that we don't have this money today and therefore we'll be borrowing to calculate the opportunity cost, that is the interest amount on the same. Students, the UK borrowing rate given in the question is 7%, and I'm very sure students you realize that if it is 7% per annum, it is 3.5% for 6 months. So children, on this 2360, I'll calculate 3.5% as the interest on the premium. So children, 2360 into 3.5%, if we do, we get pounds 82.6, rounded off to pounds 83, and with that we get our final answer. It will be 212,500 plus 13,063 plus 2360 plus 83. That will give us pounds 228,006. 228,006. Everybody following till here? Yes, and with that we complete the pound outflow as far as the options option is concerned. Let us now conclude, students. Here for concluding, children, we'll just write down the final answers of each one of them. As far as the forward cover, children, is concerned, long back we are done. Forward cover gave us a pound outflow of 236,103. Okay, 236,103. I'll write down here, pound 236,103. As far as money market is concerned, children, we got a final answer of 236,510. I'll write down here 236, okay, pound 236,510. As far as the option is concerned, our outflow, children, option means maximum outflow, which means it can be less than this also if the option goes out of money. I hope you're understanding. So students, 228,006 is our pound outflow here. So I'll write down here pound 228,006, and therefore considering the answers available in front of you, we realize that the option alternative is the cheapest and therefore the best. Everybody followed this question? Yes. So with that, students, we complete this question, this beautiful question, question number 10. Students, I hope you all understood my explanation of this question. I will now flash the solution of this question on your screen, so you can pause the video and copy it on the notes. I would recommend don't copy. In fact, just go through the video once more and try solving on your own. Yes, only then we'll get the grip on this particular concept. Yes, so thank you very much, students. Hello friends, let us now do question number 45. Students, another question on swap points which I picked up from the old practice manual. It also came in November 2016 paper for 5 marks. Okay, so let's start. I would request first of all of you all to pause the video here and read this question carefully, please. Start. Okay students, I hope you all have read the question. Let us now complete this. Very simple it is. See, they are saying on April 3rd, 2016, a bank quotes the following. Spot rates, $1 equal to rupees 66.2525, rupees 67.5945, 2 month swap points 70.90, 3 month swap points 160.186. In a spot transaction, delivery is made after 2 days. Assume spot date as April 5th, 2016. Yes, because if April 3 is the date on which the rates are quoted, the transaction, the delivery, etc. will happen in 2 days, that is April 5th. Assume one swap point equal to 0.0001. Question, don't teach us, we know all this. Okay, let's go ahead. You are required to. Of course, we know this 70 must be 0.0070. That means one swap point must be 0.0001 only, right? 70 swap points must be 0.0070 and so on. We know that. Okay, let's go ahead. You are required to, point number A, ascertain the swap points for 2 months and 15 days. That is for June 20th. From April 5th, 2.5 months means June 20th. So 2 months, 15 days swap points they want to calculate. Okay, B and C will do later. Let us complete point number A. See what I am doing here. Question 45, point number A. Okay, I'll write down here particulars, bid and ask. Okay, particulars, bid and ask. Okay, the spot rate $1 is equal to rupees, tell me what is the bid rate, 66.2525. So I'll write down here 66.2525, and the ask rate, students, is 67.5945. So I'll write down here 67.5945. Done. Students, these are the spot rates given to you. Then they have given to you the swap points 70, 90. I'll write down, these are 2 month swap points. Okay, so I'll write down here 2 month swap points will be 70, 90. Okay, and the 3 month swap point, students, will be obviously given to you 160, 186. Okay, 160 and 186. They are asking in the question, what is 2.5 month swap points? 2.5 month swap points, students. That means it must be between these two only. So 2.5 month swap points will be what? Now students, let us calculate for the bid swap first. Okay, see what I am doing. At 2 months, bid swap is 70, correct? And 3 months bid swap is 160. Correct. So what must be 2.5 months bid swap? Very simple. Can you see, as we increase the month by 1, that is from 2 months to 3 months, the swap points increase by 90, correct? That is from 70 it goes to 160. So students, if I want my month increase from 2, not by 1 month but only by 0.5 months. See, I'm again repeating, from 2, if the month increases by 1 month, the swap points increase by 90. If I want to increase the month only by 0.5, okay, then the swap point should have increased by how much? If you calculate, obviously it will be 90 into 0.5 by 1, that is 45. That means if I increase my period by 0.5 months only, the increase in swap points will be 45. Therefore students, my 2.5 months bid swap will be 70 plus 45, that is 115. Okay, 70 plus 45, that is 115. Similarly, we can solve for ask swap also. Students, see, please pay attention here. Okay, I will draw the same time scale here. 2 months, 3 months. At 2 months, the ask swap is 90, and for 3 months, the ask swap is 186. So students, for 2.5 months, the ask swap will be how much? Month I increase by 1, my swap points increase by 96, correct? From 2 months to 3 months, 1 month if I increase, swap points go from 90 to 186, that is 96 jump. If I would have jumped only by 0.5 month, for a 0.5 month jump, how much swap points will jump from 90? Will be 96 into 0.5, that is 48. Of course, divide by 1, that is 48. That is the jump. 48 is what the swap points will jump from 90 if the period jumps from 2 to 2.5. So therefore, my ask swap will be 90 plus 48, that is 138, correct? 90 plus 48, that is 138. With that students, we now get the 2.5 month swap points 115 and 138. With that, we complete point number A. Point number B, determine the forward rate for June 20, 2016. Students, June 20, 2016 means that 2.5 months after the spot. Students, we have the spot rate here. We have the 2.5 months swap points here. The swap points are in ascending order. What to do to find the forward rate? Simply add these swap points to the spot rate to find the 2.5 months forward rate. So I'll write down here June 20 forward rate, that is 2.5 months forward rate. Yes, will be, students, I will take on calci 66.2525 plus 0.0115, and as far as the ask is concerned, 67.5945 plus 0.0138, correct? Ascending order swap points will be added to the spot. Ready? So let us now do the calculation. 66.2525 plus 0.0115, correct, will give me 66.2640, and the next one students will be 67.5945 plus 0.0138 plus 0.0138 will give me 67.6083. 67.6083. Yes students, so with this we complete our 2.5 month forward rate, June 20 forward rate, $1 equal to rupees 66.2640 dash 67.6083. So with that we complete point B. Then last one students, point C, compute the annual rate of premium discount of dollar on INR on an average rate. Students, stop. Too many things here. First of all, annual rate of premium discount, that means nothing but percentage appreciation or depreciation of dollar, which means we have to take dollars appreciation or depreciation compared to rupee on an average rate. Now what that average rate means, I will tell it to you here only. See students, here if you see, I'll write down the two quotes. First of all, the spot rates. Students, what are the spot rates? Spot rates are $1 equal to rupees. The spot rates given to you are 66.2525. I'll write down here 66.2525, and the next one is 67.5945. 67.5945, correct? So with this we have the spot rates. Now we can also put the 2.5 month forward rates. $1 is equal to rupees. Just now we got 66.2525 66.2640. So I'll write down here 66.2640 and the next is 67.6083. So I'll write down here 67.6083. Students, we have the spot, we have the 2.5 months forward. Students, they are asking you the premium discount or basically the appreciation depreciation, students, of dollar on INR. Basically, we want to find the percentage up and down in dollar, correct? Students, here dollar is the product. So therefore, do you realize that the percentage appreciation or depreciation in dollar, that is the product, will be F minus S upon S into 12 by M into 100, correct? F minus S, do you remember this formula? Forward minus spot upon spot into 12 by M into 100. Students, why am I using this formula? Because this formula is of the product and they have asked us to calculate it for dollar, and dollar is our product in our quotes. Therefore, the product appreciation depreciation formula will apply. But before you start applying, children, they are telling you that you please calculate on average rate. Students, do you realize that this percentage that we will be getting is a percentage on the spot rate? It is a percentage on the spot rate. From the spot rate, it is this much that is deviated, appreciated or depreciated. But here they are saying don't calculate on the spot rate. They are very specifically saying calculate on the average rate. Students, therefore here I will not write S, I will write average rate. And what is this average rate, students? Average rate is nothing but spot plus forward divided by 2. Simple average you have to calculate. So students, this is the bid data, this is the ask data. What will be the average rate, students? Average rate for bid will be 66.2525 plus 66.2640, the whole divided by 2. So if we take the calci, 66.2525 plus 66.2640, the whole divided by 2 will give 66.2583, and as far as the ask is concerned, students, 67.5945 plus 67.6083, the whole divided by 2. If you take the calci, 67.5945 plus 67.6083, the whole divided by 2 will give me 67.6014. So this becomes your average rate. Students, once that we have got the average rate, now we can easily find the percentage appreciation depreciation in dollar. So students, percentage up and down in dollar. Let us first do on the bid rate. Students, on the bid rate, the dollar, can you see, from 66.25 something has gone to 66.26 something, which means dollar is appreciating in the forward rate as far as the bid is concerned. What will I put in the numbers here? See, please focus. It will be 66.2640 forward minus 66.2525 spot divided by, generally I would have put 66.2525, that is spot, but here they are asking us to calculate on the average rate. So I will take 66.2583, correct, into 12 by M. Students, here the M is 2.5 into 100. I hope you understood. And as far as the ask rate is concerned, forward 67.6083 minus spot 67.5945, the whole divided by average rate, that is 67.6014 into 12 by 2.5 into 100. Yes, 12 by 2.5 into 100. Students, let's take the calcis now. 66.2640 minus 66.2525 divided by 66.2583 into 12 divided by 2.5 into 100 will give me 0.0833% appreciation in dollar. This is positive, right? Hence dollar is appreciating in the 2.5 months forward rate as far as the bid rate is concerned. As far as the ask rate is concerned, students, let us take the calci. 67.6083 minus 67.5945, that is the spot, forward minus spot, divided by average rate, that is 67.6014, yes, into 12 divided by 2.5 into 100 will give me 0.098%. Okay, 0.098% is the appreciation in the ask rate of dollar. 0.083% is the appreciation in the bid rate of dollar, correct? Okay students, so thank you very much. With this we finally finish question number 45. Students, I will now flash the solution on your screens. You can copy it in your notebooks. And now with this we not only end this question, this video, but also this module of swap points. I hope you understood how the swap points are to be read and applied in the exam on the spot rates to find the forward rates. Thank you very much. See you in the next module with another concept. See you there. Hello friends, so let's now see this new question. I request everyone to pause the video and read the question carefully. It's going to run in 2 pages. Start reading. Okay students, I hope you all read the question. Let me explain the story behind this. Let's start. A USA-based company is planning to set up a software development unit in India. Oh my God, which means now we are Americans and India is a foreign country for us. Remember that. We are Americans and India is a foreign country. Okay. Software developed in that foreign unit will be brought back by the home parent at a transfer price of $10 million. The unit will remain in existence in India for 1 year. The software is expected to get developed within this time frame. The US-based company will be subject to a corporate tax of 30% and withholding tax of 10% in India and will not be eligible for tax credit in US. The software developed will be sold in the US market for $12 million. Other estimates are as follows. So they are saying rent for a fully furnished unit with necessary hardware in India, rupees 15 lakhs. Manpower, 80 software professionals will be working for 10 hours each day, rupees 400 per man hour. Administrative and other costs, rupees 12 lakhs. Advise the US company on the financial viability of the project. The rupee dollar rate is rupees 48 per dollar. So what is the story? See, listen carefully. This is USA, okay, and this is a foreign country called India, okay. Now this USA is wanting to develop a software, so they are setting up a project in India. So this project they are setting up here, they are saying, see, read carefully, planning to set up a software development unit in India. Software developed at India will be bought back by the US parent at transfer price of $10 million, which means Indian subsidiary will be able to sell what it develops at $10 million. That means the USA parent company will be buying it back, correct? I hope you realize you have to do all the calculations now from the subsidiary's point of view because the action is happening here, correct? So we will do everything from India's point of view. Later, we will do from dollars point of view. At the end, we will convert everything to dollars. Right now, you focus from India's point of view. Even though India is not your home here, focus here. For you, $10 million, can I say, is the revenue. It's a selling value, correct? Yes. And students, if you are focusing from India's point of view, the entire calculation initially we will do from rupees point of view. At the end, we'll convert it to dollars. Everybody following? We will have to convert to dollars because students, for us, the home currency is dollar, correct? So now let's proceed ahead. Then they are saying that the unit will remain in existence in India for a year. The software is expected to get developed within this time frame. That's okay. US-based company will be subject to a corporate tax of 30% and a withholding tax of 10% in India. Basically, do you realize I've explained this in the previous question that for us, the final tax rate is 30%. Yes. Now, withholding is 10%, which means balance 20 only we have to pay. Basically, total we have to pay 30. Everybody following till here. So, therefore, my tax rate, children, is 30%. In which country? In India. Okay. And will not be eligible for tax credit in USA, which means they are saying that in India, Indian government will charge 30% as the tax rate, and this you will not get as any credit in the USA market. But anyways, I'm not focusing on the USA right now. We are only focusing on the Indian subsidiary, correct? So for us, the 30% is the tax rate. So the story till now is, students, USA, the parent company is there. In India, it is setting up a project. Yes, in India, the tax rate relevant is 30%. In India, when the software is developed, they will be able to sell it to the US parent company for $10 million. $10 million, the parent company will have to pay to India. For India, it becomes revenue. Till your story is clear. Now they are saying that this software developed will be sold by US company, obviously, in the US market for $12 million, which means once it gets the software from this Indian subsidiary, USA will sell it to its customers. USA company will sell it to its customers for $12 million. Everybody following? Next, what they're saying, other estimates are as follows. So they're saying in India, we are not going to invest in fixed assets. On rent, we will take premises. 15 lakh is the rent for the premises. Labor cost is given. Admin and other costs are given. And the today's spot rate is given. Students, that means in India, if we set up this project, there is one revenue for the Indian subsidiary. This is the revenue of $10 million that we get from the US company. Also, for Indian subsidiary, there are three cash expenses. One is the rent, one is the labor, and one is admin expenses. So what you have to do, you have to simply calculate the CFAT from Indian subsidiaries point of view. Can we start? One thing we should understand is that this $10 million you're going to receive is in dollars. We have to convert it to rupees, and for that the rate given to you is $1 equal to rupees 48. Yes, so let's start. So I will now write down here calculation of CFAT. Okay, calculation of CFAT from Indian subsidiaries point of view. Students, this question is there in the institute also. I'll show it to you there how they have solved it. So please pay attention. This is question 19 of the old practice manual of ICAI. Let us now try to understand how they have done it. See, please pay attention. They are saying pro forma profit and loss account of the Indian unit, Indian subsidiary. Profit and loss account means basically CFAT we are calculating. Now revenue they have got as 48 crores. From where they got 48 crores? Students, for the Indian subsidiary, I hope you realize the sale value is $10 million and the rate, the spot rate is given as $1 equal to rupees 48. So 48 rupees into $10 million will obviously give you the revenue in rupees, correct? So it is basically $10 million into 48 gives you 48 crore rupees. Everybody there? Next, students, this revenue that they have written, you remember we used to call it as cash revenues. Next, we do less cash expenses. 15 lakh is the rent. I hope you understand. Next, they're talking of manpower. Students, 400 into 80 into 10 into 365. Why all this? Can you see 400 rupees per man hour, okay, into 10 hours per day, into 365 days, into 80 men. Everybody following? So if you multiply everything, you will get 11 crore 68 lakh as the labor expense, and admin and other expenses, students, given to you is rupees 12 lakhs. So students, this is total expenses. So 48 crore minus 11.95 crores will give you the earnings before tax, which we used to call as NPBDT. And since there is no depreciation mentioned in the question, it is NPBT. In fact, depreciation won't be there only because you're not purchasing any fixed asset, correct? You're taking the premise on rent. So NPBT is your final profit before tax. Now students, this less tax onwards, okay, less tax onwards, this entire chunk. Students, the institute is saying that you can either do it like this, or alternatively there is another answer given to you, or alternatively another answer is given to you. Can you see? Yes, so basically we have got three answers given by the institute. 36 crore 5 lakhs is common. See, you can see that even here it is there and even here it is there, but what is changing is how they have treated tax. Okay students, I hope you saw there were three solutions given to you in the ICAI for the tax treatment. I am the most comfortable with the third one, so I'm going ahead with it. If you want, you can read the first two also separately on your own. The practice manual is available on the institute's website. Let me now straight away go to the third one, that is this one, correct? We already have the 36 crore 5 lakh as the NPBT, correct? NPBT. Now what they are saying in this is, they are saying it is assumed that the withholding tax of 10% is being paid, and then its credit is taken in the payment of corporate tax. Basically they are saying your corporate tax is 30%, correct? So 10% you have already paid, so balance only 20 you have to pay. Everybody following? Which means like in the previous question we did, straight away I took 30%, right? 30% you take, that means nothing but 10% first and then 20%. Answer will remain same, correct? So in the previous question question, obviously the tax rate was 40% and withholding tax was 10%, but I didn't do 40 separate, 10 separate. I straight away took 40 one shot, which means it is 10% we pay first, then 30% we pay as the corporate tax. Similarly, here the corporate tax is 30%, withholding is 10, which means first we pay 10 and then balance only 20 we pay. Everybody following? So here can you see, students, they have straight away taken withholding tax of 10% of NPBT and then they have taken the balance 20% tax of NPBT. This is 10% of 36.05 crores. This is 20% of 36.05 crores. And with that, students, once we pay this 30% total tax, the final CFAT we get, students. Why am I calling it a CFAT? NPAT CFAT here is same because there is no depreciation. The final CFAT we get is 25 crore 23 lakh 50,000 rupees, correct, in rupees. And these rupees is what this particular Indian subsidiary will be finally repatriating to USA. Everybody following? It will be repatriating to USA. Tell me how much is the money? 25 crore 23 lakh 50,000. Write it down here. 25 crore 23 lakh 50,000. Now children, think from USA's point of view. USA is paying 10 million to the Indian subsidiary to purchase this particular software from the Indian subsidiary, correct? So on one hand, it is paying 10 million to the Indian subsidiary. On the other hand, it is receiving 25 crore 23 lakh 50,000 rupees from the Indian subsidiary. Can I say, considering 48 rupees per dollar as the rate, if I divide this by 48, this comes to how many dollars? 25, 23, 50,000 divided by 48. This comes to 5257291. Yes, 5257291. That is what they're doing here. And that is of course 0.66 in the decimal, which means it is rounded off to $5257292. I hope you got this. Okay. So therefore, as far as the US company is concerned, children, what is happening is they are paying 10 million to the Indian subsidiary. They are receiving $5257291 from the Indian subsidiary. That is nothing but 52,57,291, correct? So children, tell me now, 52 lakh means how many million? Do you realize it is $5.257 million, correct? So basically from the US point of view, if you think, they paid $10 million, they received $5.257 million. So net what they have paid is 10 minus 5.257, that is $4.743 million, correct? That means for purchasing this software from the Indian subsidiary, gross they paid $10 million. Equivalent dollars they received from the Indian subsidiary is 5.257. So net they have ended up paying $4.743 million. And on the other hand, once they get this software by paying this net $4.743 million, they are selling it to their customer, students, at $12 million, correct? I hope you are understanding. So for the US subsidiary, it is a profitable business, correct? To purchase this software, net they are paying 4.743 and outside they are selling it at 12 million. It is a gain for the US subsidiary. This particular project of India should be accepted by this USA company. That is what they are saying. Look at the institute's language. Advice: the cost of development software in India for the US based company is $4.743 million. As the USA based company is expected to sell the software in US at 12 million, it is advised to develop the software, correct? Purchase price is 4.73, sell price is 12. Why not go for it? Yes. So students, with this we complete this question. Yes, I hope you understood this question. Thank you very much. This solution I'll flash in front of your screens now. You can pause the video and copy down the solution. Thank you very much. See you in the next video with another question. Hello friends, welcome to this video where we will be discussing one question based on this concept of interest rate caps. I request everyone to first of all pause the video and read the question carefully. Start. Okay students, I hope you all read the question. The solution to this question is slightly debatable. Where the debate is, let's not go into it, but I will still tell you exactly what ICAI is doing. Okay. Now their presentation is slightly difficult to comprehend. It will appear slightly difficult to understand. I'll explain it to you in the way you understand it, but the solution will of course tally with institute, right? Now let's start. First of all, what are they saying? XYZ Limited borrows 15 million pounds of 6 months LIBOR plus 10% for a period of 24 months. Now first of all, understand how much is the principal. Now children, do you realize the principal is 15 million pounds? Now I hope you realize what is 15 million. It is 15 into 10 into 1 lakhs, right? Just kidding with you. Basically it is 15 into 10 lakhs, right? So students, I'll take the calci. I'll do 15 into 10 lakhs. Okay. And I'll write down the number here. 15000000. Okay. This is basically, do you realize, 150 lakhs. Everyone clear? Now, the company is anticipating a rise in the LIBOR and hence it proposes to buy a cap option from its bankers. Now students, if you have taken a loan and your loan interest rate that you have to pay is a floating interest rate, it is dependent on this LIBOR, do you realize you'll of course be fearing a rise in the interest rates, because a rise in the interest rates will end up you paying more interest, right? So in order to safeguard yourself, you would want to go for a call option, that is a cap option at a strike price of 8%. What is the meaning of strike price or strike rate of 8%? It means that if the LIBOR crosses 8%, right? If the LIBOR crosses 8%, then children, you are in the money, right? Because in a call option or a cap option, if S1 is greater than K, right? We are in the money, we will be getting profits there, right? So students, yes, on one side, in the cash market, you will be paying higher interest, but on the other side you will be compensated from the option, because if the interest rates go high, I hope you realize you will be getting profits there, you will be in the money. Of course, if the interest rates go low, then do you realize you're out of money, the option is useless, and at the same time you will be paying lower interests in the cash market. Now moving on, the lump sum premium is 1% for the entire reset periods. Now students, do you understand? You are having a period of borrowing for how many months? 24 months. 24 months means, do you realize, 2 years? And in 2 years, do you realize if 6 months LIBOR I'm picking up, which means every 6 months it resets, do you realize there are 4 reset periods? Everybody agrees with me, there are 4 reset periods. Now if there are 4 reset periods, how do I calculate the premium to be paid? First of all, understand they are saying premium is 1% of the entire, which means 15 million, that is nothing but 150 lakh pounds into 1%. Now into 1% means, do you realize it is 1,50,000 pounds? Students, this is the lump sum premium that you have to pay. Everybody understanding? This is the lump sum premium you have to pay, and lump sum premium of course you have to pay today only. Do you agree with me? But if I want to find out what is the equivalent premium that I am paying on a per period basis, I am again telling you, this 1,50,000 you are not paying on a per period basis, you are paying today only. But if you just want to find out the equivalent per period basis, then do you realize you will have to divide this by 4. Everybody agreeing with me? You have to divide this by 4. But if you divide this by 4, the number that you get, can I say, yes, it is quarterly basis, right? Or basically 6 monthly over a 2-year basis, over 4 periods. But this is ignoring time value of money. Everybody agreeing with me? This is ignoring time value of money. Ignoring time value of money means what? It means that, okay, 1,50,000 divided by 4, if you do, you get 37,500. I'll just draw something here for you. This is year 0, or basically period 0. This is period 1, period 2, period 3 and period 4. You have to pay pounds 1,50,000. I want to know this is equivalent to how much here? Everybody clear? I want to know it is equivalent to how much here? If you simply divide this by 4, then this 37,500 that you get, yes, 37,500, 37,500, 37,500, 4 numbers equals to 150, but they are all as of time 0 only, right? I do not want the 4 bifurcations as on this time period only. I want the 4 bifurcations as on these time periods at the end of period 1, 2, 3 and 4. So for that, if we have to take the time value of money into consideration, do you understand that the present value of those 4 X payments should be equal to present value of pound 1,50,000. Do you agree with me? The present value of all of these should be equivalent to present value of this, only then they are comparables, right? So present value of 1,50,000 is what? It is 1,50,000 into 1, and present value of these 4x, can I say, will be x into the annuity factor of this fixed interest rate given to you, right? They have given to you the discounting factor of 7% per annum, which means, do you realize it will be 7% per annum means, do you realize 3.5% per period for 4 periods? Everybody clear? So this is 1,50,000 is equal to x into, now PVAF you all know is nothing but the total of 4 discounting factors. 1 divided by 1.035, this is 0.9662 plus 0.9335 plus we will do 0.9019 and plus 0.8714. Everyone clear? I can press GT also and do it, but I'm just adding up the 4 decimals, right? So this is 1,50,000 is equal to x into, now this is 0.9662 plus 0.9335 plus 0.9019 plus 0.8714, and this comes to 3.673. okay, 3.673, and therefore do you realize your x would be 1,50,000 divided by 3.6730. okay, so this is 1,50,000 divided by 3.6730, and this comes to 40,839. 40,839. Everybody clear? This is the equivalent premium. Everybody clear? This is the equivalent premium per period. Done. I am not saying that you have to pay this. I am saying you have to pay this only today. But paying this today is equivalent to paying 40,839 per period, right? Because the present value of all these 40,839s is equal to 1,50,000, and therefore paying 1,50,000 today is equivalent to paying 40,839 per period. Everybody clear? Great. Now what are they asking you? They are asking you the actual position of LIBOR during the forthcoming periods are as follows. So these 3 reset periods they have given to you, and they are saying that the LIBOR would be 9, 9.5 or 10%. Now you tell me, if the LIBOR is 9%, do you realize you have a cap of 8%? That means the LIBOR S1 has gone above K. Do you realize you are in the money to the extent of 1% here per annum? Everyone clear? That is 9% minus 8%. In the second case, you are having a gain of 1.5% from the cap option. In the third case, you are having a gain of 2% from the cap option. Basically, what I'm trying to say is, in the spot market or in the cash market, this is what extra you have to pay over and above 8%, right? Because you thought that your cap is 8, but it is crossing the cap. This is the extra you have to pay, but this extra that you have to pay, you will be compensated from the option in the form of net gain or net payoff from the option. Everybody clear? So if I show it to you here, do you realize additional interest to be paid? Okay, additional interest to be paid in the cash market or the spot market would be what? Do you realize it would be, now I'll write down here, pound 150 lakhs multiplied by, okay, 1%, okay, multiplied by 1% into 6 by 12. Everybody clear? Into 6 by 12. So 150 lakhs into 1% into 6 divided by 12, okay, that will give you 75,000 pounds that you have to pay extra. Now do you realize the payoff under the cap option? Okay, payoff under the cap option, if 75,000 extra you have to pay here, I hope you realize 75,000 only you will be getting as the payoff from the cap option. Everyone clear? So here you're paying this extra, but you're getting compensated also because you're taking this cap option here. Now children, do you realize for getting this benefit you had to pay a premium? Everybody clear? You had to pay a premium. How much premium you had to pay? Yes, you had to pay 1,50,000 lump sum premium today, but that is equivalent to how much per period? 40,839. okay, 40,839. So do you realize the net payoff under the cap option, okay, would be 75,000 minus 40,839, and that comes to 34,161. Everybody clear? 34,161. Children, this is your gross payoff. I hope you're understanding. And then minus premium will give you the net payoff. In the second period, I hope you realize 1.5% is the extra interest you're paying. So 150 lakh into 1.5% into 6 by 12. Okay, so 150 into 1.5% into 6 divided by 12. You are paying 1,12,500 pounds extra. You will get 1,12,500 pounds gross payoff from the cap option, for which you had to effectively pay 40,839. So 1,12,500 minus 40,839. You will get net payoff of 71,661. And in the last case, 2% extra you are paying. So that is pound 150 lakh into 2% into 6 by 12. So this is 150 into 2% into 6 by 12. You are paying 1,50,000 extra pounds interest in the cash market. You will be compensated with the same amount here, for which you had to pay 40,839, right? So 1,50,000 minus 4839, you are going to net receive 109,161. Everybody clear? Now that this is done, what are they asking? You are required to show how far the interest rate risk can be hedged through the cap option for calculation. Work out figures at each stage up to 4 decimal points. I hope you're understanding why I did that PVEF not using GT or M plus MRC. I actually added the 4 decimal points. It should be part of the working notes. Yes, we have shown it. So they are asking you how the interest rate risk is hedged. This is exactly the answer, right? One thing you could do is that, see, you can take a total here. This is 75,000 plus 1,12,500 plus 1,50,000. A total additional interest you had to pay was 3,37,500 pounds because the interest rates went up. But here you got compensated also, right? 34,161 plus 71,661 plus 109,161. You got a compensation of 214,983 pounds. Everyone clear? Basically, you are getting the whole compensation, but for this entire facility you have to pay this much premium, right? So I hope you realize the total of this premium is the total payout that you have to do. This is the additional interest, right? This is the additional interest that you have to pay, and therefore this is exactly the additional interest that you will be getting. But for getting that additional interest, you have to pay this much, and therefore this is the net that you're getting. Everyone clear? So end to end, if you see, yes, I paid additional interest of 3,37,500 in the cash market, but the derivative option gave me back a compensation of around 2,14,983. Everybody clear? So with that, we complete the discussion to this very simple question. I hope you understood it. I'll now flash the solution of this video on your screens. You can pause the video and copy down the notes. Thank you so much. We'll see you in the next video. Hello friends, so one last question of EVA, question number 32. Children, I request everyone to kindly pause the video and read the question carefully. Okay students, I hope you all read the question, and I'm very sure you are finding it very simple. So I'll read it for you now, but I want you to try on your own. Can you try? I'm announcing this question as a test. Of course, I will be discussing it for you. Delta Limited's current financial year's income statement reports its net income as 15 lakh. Children, this is your NPAT. Delta's marginal tax rate is 40%. This is your tax rate. Its interest expense for the year was 15 lakh. This is your interest amount, okay, in rupees. The company has 1 crore of invested capital. This is your total capital employed. Everybody following? Of which 60% is debt, which means, can I say, weight of debt is 0.6. Weight of equity, children, yes, is 0.4. Everybody following? In addition, Delta tries to maintain a weighted average cost of capital of 12.6%. This is your WACC. Everything is given. Compute the operating income or EBIT earned by Delta in the current year. Children, you have the NPAT, you have the tax rate, you have the interest amount. Can you go reverse engineering upstairs from NPAT to EBIT like we did in the previous question and find EBIT? Yes, so point number 1 you can easily do. Point number 2, what is the EVA? Children, can I say a very similar question to the previous one? Once you get the EBIT into 1 minus T minus total capital employed into WACC will give you the EVA. So many sums you have done. I'm very sure you can solve on your own. Now children, the last point, third, I'll discuss for you all. Let's say, okay, let's say children, your EVA comes to 10 lakhs. Okay, let's say your EVA comes to 10 lakh. 10 lakh is what, children? Can I say it is the additional earning that you have earned over and above what your investors want, correct? Your investors want TCE into WACC. You have earned EBIT into 1 minus T. EVA is what is you have additional earned. Everybody following? They're saying let's say Delta has 2.5 lakh equity shares outstanding. According to the EVA you computed into how much can Delta pay in dividend per share before the value of the company would start to decrease? Can I say if you have got additional 10 lakh as your income EVA, can I say 2.5 lakh if the number of equity shares? Can I say we can pay off 4 rupees per share as dividend? Everybody following? We can pay 4 rupees per share as dividend because that is the extra we have. We can pay it off, correct? Then they're saying if Delta does not pay any dividends, what do you expect to happen to the value of the company? Of course, if you don't pay dividend, then the value of the company will keep rising because now you are financially very healthy. You have got around 10 lakh rupees extra with you. The value will keep rising. Everybody following? If you give dividends, the value will remain where it is only because the investors will say that whatever EVA you had, you distributed it. Now in the company, there is no more EVA. So if you distribute everything to the shareholders, then do you realize the company's value won't grow? But if this EVA is kept in the company, reinvested for further growth, of course, the company's value will grow. Everybody following? So with that, students, I announce this question number 32 as a test. I request everyone to sincerely try it. Of course, the solutions will be given to you. It will be flashed on your screens. You can, of course, then pause the video and tally your answers with mine. I am very sure they will be right. Yes, they will be, of course, right. Now, children, at this juncture, I want to talk to you for a minute. Please pay attention. We have completed 32 big important questions on corporate valuation now. We have covered all aspects. Yes, everything is covered by me. Now, children, at this juncture, I want to tell you that for more practice, okay, if you want to do more practice, self-practice, I have placed 8 more questions, okay? 8 more questions from question 33 to question 40. I have placed 8 more questions for your self-practice. All of these questions, children, are from ICAI only, either recent questions or past questions, but additional questions for you. And I have also, of course, given to you the solutions also. So you have the questions, you have the solutions for self-practice. If you want, you may go through these questions. Trust me, no new concept is there, just new questions are there, which I would like that all of you should go through. I have taken a lot of hard work to actually identify those questions and place it at the end of your chapter. These are not restricted to specific modules of this chapter. These can be from any module. It is a mixed bag of questions for your self-practice. 8 questions, and can I say with that, therefore, students, you will be completing 40 questions in corporate valuation. Yes, and of course, if you have any doubt, yes, if you have any doubt in those questions also from question 33 to question 40, you are welcome to ask me. It is your right to ask me, and it is my duty to solve them. Yes, I am very sure you will have no doubts. The solutions are very clear, but my request is once you see that question, kindly first try to solve on your own and then tally with the solution. Most of the times, if you have done it wrong, you will understand your mistake. See, first of all, I'm very sure you will not be wrong. But if it is wrong, in that, I'm very sure most of the time you will understand what your mistake is. But if in case you do not understand what your mistake is, or you are not agreeing with the solution, or you find some error, whatever, kindly reach out. Okay, kindly reach out. JKSC online platform is providing you a doubt solving platform, also a doubt solving portal. Also, the doubts will reach me and I will definitely solve your doubts. Either I will solve your doubts through writing, or if I feel that a video is required for the same, that also I will shoot an issue for you so that you are completely comfortable. Yes, so students, from my side, I'm giving you a gift of 8 more questions. See, actually the product for corporate valuation included 32 questions only, but I thought let me give more questions for self-practice. So 8 more, kindly do it. Okay, so thank you very much, students. With this, we complete this beautiful chapter of corporate valuation. Thank you so much. See you in the next chapter in this beautiful journey of SFM. Thank you so much. Hello friends, so welcome to this question 28. As I had been discussing in the previous video, let's now try to understand this question. I request everyone to please pause the video and read the question carefully. Start. Okay students, I hope you all read the question. Let us now try to understand this. Okay, see, AFC wishes to acquire BCD Limited. The shares issued by the two companies are 10 lakh and 5 lakh respectively. Calculate the increase in the total value of BCD Limited resulting from the acquisition on the basis of the following conditions. So in the first paragraph, they are saying that there is a company called AFC, which is the acquiring company, and there is another company called BCD, which is the target company. So the acquiring company wishes to take over target company. The shares issued by the two companies are 10 lakh and 5 lakh respectively to their respective shareholders. These are their pre-merger number of equity shares outstanding. They are saying calculate the increase in the total value of the target limited resulting from the acquisition on the basis of the following conditions. Let's see what they are saying. They are saying current expected growth rate of the target limited is 7%, but the expected growth rate under the control of the acquiring company without any additional capital investment and without any change in risk of operations is going to increase from 7% to 8%. Everybody following? Yes, so this was exactly what I was telling you in the previous video when I was telling you that the target limited's growth rate will now swell up under the management of the acquiring company. They're saying the current market price per share of the acquiring company is 100. Then they say the current market price per share of the target limited is rupees 20. The current dividend per share of BCD Limited is rupees 0.6. On the basis of the above conditions, calculate the gain or loss to the shareholders of both the companies if AFC were to offer one of its shares for every 4 shares of BCD. Then they say calculate the gain to the shareholder. Students, this part is like part 2 of the question. We will see that later. First of all, let us complete the question till here only. Can we start? So tell me what is happening here. They are saying that AFC wishes to acquire BCD, and they are saying that AFC and BCD both have existing number of equity shares given to you. They are asking you to calculate the increase in the total value of the target limited due to this merger. In that they say that the target limited's existing growth rate was 7%, but the expected growth rate is going to be 8% in the management of the new acquiring company, due to which obviously the value of the target limited in the acquiring company will obviously swell up beyond its current pre-merger value. This is the current pre-merger MPS of the acquiring company. This is the pre-merger MPS of the target company, and this is the D1 expected of the target company. Everybody following? They're saying on the basis of the aforesaid condition, calculate the gain or loss to shareholders of both companies if AFC were to offer one of its shares for every 4 shares of BCD. Basically, students, 2 things are being asked. First of all, they're asking you increase in value. Secondly, they're asking you gain loss to the shareholders. Basically, you know what to do, impact on MPS for both shareholders, correct? So first of all, let us knock off this increase in the total value. Can we start? So students, I'm writing here question number 28. In that point number 1, in that point number A, calculation of increase in total value of the target limited, that is BCD. Yes, students, tell me what is BCD's pre-merger MPS. Okay, I'll write down pre-merger MPS, which can be also written as P0. P0 of BCD, students, is 20 rupees, right? So I'll write down here rupees 20. Everybody there? So rupees 20 is the P0 of target limited. As far as D1 is concerned, they have given to you in the question D1 is 0.6. I'm just putting the data down. I'll make sense to you in some time. Please pay attention. So P0 is there rupees 20, D1 is rupees 60, and they are saying the current growth rate, right? The current growth rate is 7%. I'll write down G equal to 7%. Come on, children, tell me what can you find? You have the P0, you have the D1, you have the G. With this, what can you find? Can I see you can find KE? I'll write down here KE is equal to D1 upon P0 plus G. Yes, K equal to D1 upon P0 plus G, which is equal to 0.6 upon 20 plus 7%. And on the calcs now, 0.6 divided by 20% plus 7 gives us K as 10%. Students, you know what I'm teaching you here? I am teaching you how to calculate the revised value of the target limited due to this acquisition. Basically, in that acquisition, more specifically, due to that new management's impact on the growth rate of the earnings and dividends of the target limited is going to now swell up from 7% to 8%. Due to that, there is going to be an increase in the value of target limited. Students, I am now right now going to teach you how to calculate that increased revised value of the target limited under the new management of the acquiring company. For that, its basic current data I am taking down. Can I say the current MPS, that is current P0, pre-merger P0 is 20, D1 expected is 0.6, growth rate was 7%. Using all this, we could easily find the KE of this company BCD Limited. Now children, tell me, what do I do? Do you realize that this 10% KE will remain fixed only, but as far as the growth rate is concerned, children, do you realize the growth rate is now expected to change? It's expected to grow to how much percent? 8% under the control and management of AFC, due to which, do you realize this 20 rupees share price will now revise? Everybody following? Because this 20 rupees share price was on the basis of a 7% growth rate. If the growth rate is going to grow to 8%, the price will change. But this price, students, I am very sure you understand, is not a price that will be traded in the market. It is just that when the target limited enters the acquiring company, the price at which it goes in the acquiring company won't be rupees 20 per share, but will be at a rate higher than rupees 20 per share, because the growth rate under the management of acquiring company will swell up, and therefore the post-merger market cap of the acquiring company will swell up. It will be more than simply the sum of the pre-merger market caps of A&T, as I discussed in the previous video. Everybody following? So let us now calculate what is the market price, the revised market price per share of target limited, which will be taken as being entering into the acquiring limited. Everybody following? So students, let's now recalculate MPS. See what I'm doing here. Calculation of revised MPS, or basically P0. Yes, the theoretical price we're calculating. What is the formula? Can I say P0 is equal to D1 upon KE minus G? Tell me, D1 will continue to remain 0.6, KE will continue to remain 10%, but the growth rate now from 7 is swelling up to 8%. Let's see what is the revised price. 0.6 divided by 2% will give me a revised price of rupees 30. Are you listening? So therefore, children, this share of BCD Limited, see, please pay attention. BCD Limited was a company, the target company. It was having number of equity shares already issued pre-merger. The market price per share of that particular company was rupees 20. Now ACD is saying that we are acquiring you as a whole. So when you come inside my world, what is happening is your existing growth rate of 7% will now not hold true. Your company under my management will have a growth rate of how much percent? 8%, which means this company, which is having a market price per share of 20, is entering into ACD, but as it enters into ACD, the value of the target limited obviously will swell up as it enters inside, because BCD Limited now is having a higher growth rate, and therefore its valuation in this acquiring company's world will swell up beyond rupees 20 per share. Everybody clear? As I've clearly explained to you in the previous video, and we found that value at 8% growth rate, the value under the management of AFC will swell up to rupees 30. My question to you is, are there shares of rupees 30 of BCD available in the market? No. BCD will cease to exist. That's the whole point. If BCD was running on its own, then the value per share would have been 20. If someone wants to buy a share of BCD, they have to pay rupees 20. But the fact is that when BCD is entering into AFC, it is going as a share worth 30. That's it. These 30 rupees shares are not available outside for public. AFC has already taken it over. Everybody following? So rupees 30 therefore is the revised MPS of BCD Limited, that is target limited. Students, tell me, in this target limited, how many existing number of equity shares are there? 5 lakh. Can I say its current market cap is 5 lakh into rupees 20, but now its market cap as it enters into AFC is 5 lakh into 30, and therefore we can easily find out the increase in the total value of BCD. Can we start? So I'll write down here. Therefore, increase in total value of BCD due to acquisition, can I say, will be 30 minus 20 into 5 lakh. Everybody following? 30 minus 20 into 5 lakh. So that is nothing but rupees 50 lakhs. What is rupees 50 lakh? Students, this company called BCD, yes, pre-merger market cap was 5 lakh into 20, that is rupees 1 crore. Okay, 5 lakh into 20, that is rupees 1 crore. 1 crore was the market cap of BCD Limited, and there is this big company called AFC Limited. When BCD enters into AFC, I hope you understand, it is going inside as a company worth 5 lakh shares into 30, that is 1.5 crores. Yes, therefore do you realize there is a jump of 50 lakhs in its valuation in the post-merged firm, that is due to merger. Everybody following? So with that we finished the increase calculation in the total value of BCD. Now students, please pay attention. What are they asking you also? They are saying calculate the gain or loss to shareholders of both companies if AFC were to offer one of its shares for every 4 shares. Basically the impact on MPS is to be calculated. The share exchange ratio given to you is 1:4. 1:4 children means what? Can I say 0.25:1? Are you there? Let's start. So for calculating the impact on MPS, I'll write down here point number B, calculation of impact on shareholders' wealth. Okay, calculation of impact on shareholders' wealth. For that, students, do you realize we will require the pre-merger and post-merger MPS? Pre-merger MPS is available to us. What we need to calculate is the post-merger MPS. Are you listening? So I'll write down here post-merger MPS. Now children, which assumption, which methodology, which technique will I follow to calculate post-merger MPS? I told you very clearly in the previous video. Even when the cost of merger module started, in that also I told you about this particular sum and this particular concept, that in this case where the growth rate of earnings and dividends of the target limited changes under the management of acquiring company, for post-merger MPS, don't go for that P ratio same assumption. Please go for the market cap assumption. Everybody following? So can I say post-merger MPS will be nothing but post-merger market cap upon post-merger number of equity shares. Let us now focus on post-merger market cap. As far as the acquiring company is concerned, children, do you realize that its pre-merger market cap will be 10 lakh into rupees 100? Everybody following? 10 lakh into rupees 100 will be its pre-merger market cap. So I'll write down here 10 lakh into 100 is the pre-merger market cap. That will continue as it is in the post-merger also. But now do you realize another company is entering? What is the company that is entering? BCD Limited. How many shares are there? Can I say 5 lakh shares are there? But the market cap of that company now, children, I hope you remember the company entering into AFC. See, do you realize we need the market cap of this entire company? AFC's existing market cap we have already taken into consideration. That is nothing but 10 lakh into 100. It is already done. But as far as this BCD coming inside is concerned, do you realize the market cap is not 1 crore but 1.5 crore, because under management of A Limited it swells up. The market cap of Target Limited swells up because the growth rate in earnings and dividends is going up from 7% to 8%. 1.5 crores from where I got? It is nothing but 5 lakh shares into rupees 30, correct? So I'll write down here plus 5 lakh shares into rupees 30. So students, can you see post-merger market cap? How is it swelling up? First of all, the pre-merger market cap of A as it is we are taking, plus the new company which is coming in had a pre-merger market cap of 5 lakh into 20. But because under our management, the price of the share is swelling up to 30, because the growth rate is going up, the market cap will be taken as 5 lakh into rupees 30. Everybody following? The whole divided by post-merger number of equity shares. As far as A Limited is concerned, already 10 lakh shares are there. That will remain as it is post-merger, plus we are offering 0.25:1 share exchange ratio. If you remember, 0.25:1 is the share exchange ratio here. If you can see this, yes. So 0.25:1 is the share exchange ratio. How many shares are there in the Target Limited? 5 lakh. So how many shares will we be issuing for acquiring Target Limited? 5 lakh into 0.25. Everybody following? I'll write down here plus 5 lakh into 0.25. Yes, so now let's take the calcs and solve this. 10 lakh into 100, students, is 1000 lakh, plus 5 lakh into 30 is 150 lakh, the whole upon 10 lakh plus 5 lakh into 0.25 is 1.25. So 10 lakh plus 1.25 will be 11.25 lakh. We will get the post-merger MPS. Students, 1000 plus 150 divided by 11.25. If I do, I get 102.22 rupees as the post-merger MPS. And now that we have the post-merger MPS, can we easily find the impact on shareholders' wealth? That is nothing but the gain or loss accruing to the shareholders due to merger. That is nothing but the comparison of post-merger MPS with the pre-merger MPS. I'll write down here. What are the two companies? AFC and BCD. Yes, I'll write down here post-merger MPS minus pre-merger MPS will give us the gain or the loss. I'll write down here gain or loss. Tell me, one share of AFC earlier was having how much MPS? It was having rupees 100 MPS pre-merger. So I'll write down here rupees 100. And as far as BCD is concerned, we know we have discussed so much. It was worth rupees 20 earlier. Now the post-merger MPS, students, is 102.22. I'll write down here 102.22. Therefore, the gain to a shareholder of AFC Limited, if he was holding one share pre-merger and he continues to hold one share post-merger also, will be 2.22 gain. Everybody following? As far as shareholder of BCD is concerned, if he was owning one share of BCD earlier, he was having wealth of rupees 20. Do you realize now he will be holding 0.25 shares in the acquiring company? So I'll write down here 102.22 is the market price post-merger of one share of acquiring company. I multiply by 0.25. I'll get the equivalent MPS for this shareholder of BCD who was holding one share earlier in BCD. So 102.22 into 0.25 if I do, I get 25.555 as the post-merger equivalent MPS. So 25.555 minus 20 will give us 5.555 as the gain for the shareholders of BCD. Basically, for both shareholders, there is a gain here. Everybody clear? So with that, we complete this first point of the question. Let us now complete the second point. This part is remaining. Can we start? They are saying also calculate the gain to the shareholders of both the companies if AFC pays rupees 22 for each share of BCD. Assuming the P ratio of AFC does not change after the merger, EPS of AFC is 8 and that of BCD is 2.5. It is assumed that AFC invests its cash to earn 10% return. Now please pay attention, this is a completely different universe. They are saying that wait, we are not going to give PC in shares, we are going to give PC in cash. If we are giving PC in cash, what is the gain to the shareholders of both companies under all these calculations? Various data given to us. Can we start? Now please pay attention. As far as the Target Limited is concerned, very simple. Can I say they were having a share worth 20? For every share worth 20, they are getting rupees 22 as cash. Straight away, their gain is over 2 rupees per share. Nothing else to be done. Cash paid per share minus the value of each share pre-merger is the gain to the shareholders of Target Limited. I'll straight away write down here. Okay, I'll write down here gain to shareholders of Target Limited, that is BCD Limited, per share is nothing but 22 rupees per share. We are giving 20 rupees the market price per share. Straight away rupees 2 is the gain to the shareholders of Target Limited per share. Everybody following? But as far as the acquiring company is concerned, children, do you realize that for a shareholder of the acquiring company, he was holding one share earlier, he will continue to hold one share later also. For his gain or loss, I will have to compare the post-merger MPS with the pre-merger MPS. Everybody following? So I'll write down here for the acquiring company, that is AFC Limited, it will be post-merger MPS minus pre-merger MPS will give us the gain or loss. We all know this is 100. Let us find this. Can we start? Now children, please pay attention. As far as post-merger MPS is concerned, we cannot take the earlier one that we got because those were under completely different situations and conditions. Here things are changing. Let's try to understand. They are saying that you calculate the MPS assuming that the P ratio will remain same, which means suddenly in this part of the question, we go back to the original assumption for post-merger MPS that the PE ratio will remain constant, which means students, do you realize that post-merger MPS is nothing but post-merger EPS into post-merger PE ratio. Everybody following? So our whole target now is to find out the post-merger EPS and post-merger PE ratio. Can we start? So what all data is available for us? They are saying that the EPS of AFC is rupees 8. But is this post-merger EPS? No. They are saying EPS of AFC is 8, that of BCD is 2.5. Basically, they are talking of the pre-merger EPS. So at least pre-merger EPS I have. Students, but they have not given to us the PE ratio. From where do I find the pre-merger PE ratio, which I am going to assume to be same as the post-merger PE ratio also? Very simple. They have given to us the pre-merger EPS of acquiring company as 8. They have also given to us the pre-merger market price per share of acquiring company, that is 100. Can I say MPS upon EPS will give us the pre-merger PE ratio? Everybody following? So I'll write down here pre-merger PE ratio will be pre-merger MPS upon pre-merger EPS, that is 100 divided by 8. Everybody following? I'll write down here 100 divided by 8 on the calci. 100 divided by 8 if I do, I get the pre-merger P ratio as 12.5, which I will assume to be same as post-merger according to the question. Everybody clear? Now the only thing we need to find out is the post-merger EPS, and that you are champions in calculating post-merger EPS, right? Now please pay attention. See what I'm doing. Calculation of post-merger earnings per share. Okay, calculation of post-merger earnings per share. What data is available? Do you realize that as far as the EPS of A Limited is concerned, it is 8, and the number of equity shares outstanding in A Limited is 10 lakh, which means, can I say AFC shares 10 lakhs into 8, 80 lakh is the pre-merger earnings of the acquiring company. So I'll write down here 10 lakh is the number of equity shares into the pre-merger EPS, that is 8. That will give me pre-merger total earnings of the acquiring company, plus, can I say, we will add the pre-merger earnings of the target company. As far as target company is concerned, their earnings per share, students, is 2.5. 2.5 is the earnings per share, and children, can you see the number of equity shares are 5 lakh. So can I say 5 lakh into 2.5 will give us the pre-merger earnings of Target Limited. I'll write down here 5 lakhs into 2.5. Everybody clear? Why have I left so much space here? Please pay attention. Before I start explaining to you that space, first of all, let's complete that denominator also. Post-merger EPS is nothing but post-merger earnings upon post-merger number of equity shares. Post-merger number of equity shares will be how much? Can I say, as far as the acquiring company is concerned, already 10 lakh shares are outstanding. Those will continue post-merger also. I'll write down 10 lakh plus. Now for acquiring the new company, Target Limited, BCD Limited, AFC is issuing how many shares? 0. No shares, because in this case they are paying the PC in cash. I hope you understand. So the denominator will continue to remain 10 lakh shares only. Now let us understand why I kept this big gap here. Please focus. What is this question saying? They are saying that for acquiring this Target Limited, acquiring company is going to pay rupees 22 per share as cash. Students, they have got 5 lakh shares outstanding in the Target Limited. So do you realize total cash that must have been paid is 5 lakh into 22. Everybody following? 5 lakh shares are there outstanding in the Target Limited, and 22 rupees is the cash to be paid per share. So 5 lakh into 22 will be the total cash we are paying on the calci. 5 into 22. Do you realize 110 lakh rupees is paid? And they say in the question that the cash generally is invested to earn a 10% return. Cash is invested to generate a 10% return, which means, students, do you realize that this 110 lakhs must have been invested somewhere at the rate 10%. We broke that investment. We stopped that investment. We said, no, we don't want this 10% because we want to acquire Target Limited. Do you realize this 110 lakhs into 10% interest we now lose from coming here onwards? And I hope you have the intelligence to understand that when we must have calculated this EPS of 8 in the question, they straight away gave you that the pre-merger EPS of acquiring company is 8. Do you realize in that the returns that you must have earned on your 110 lakh rupees investment somewhere must have been included in this EPS of 8, because EPS, students, comes after everything, right? Sales minus variable cost minus fixed cost will give EBIT, minus interest will give the EBT, and then, students, in that you add, subtract non-operating income expenses. Do you realize 110 lakh that you had in the company as AFC, which you had invested already outside at the rate 10%? Do you realize 110 lakh into 10%, 11 lakh must have been a non-operating income that must have already been sitting in your income statement, and therefore in the EPS of 8 rupees, that 11 lakh rupees interest or return, whatever you want to call it as, that is 110 lakh into 10%, must also be embedded in that EPS. Everybody following? But the moment now we say that 22 rupees per share, that means 110 lakh rupees if you are withdrawing from these investments, do you realize straight away you lose 11 lakh rupees per annum earnings? Thereby, do you realize that the acquiring company's earnings post merger won't continue to be 10 lakh into 8, that is 80 lakh, but from this 110 lakh into 10% will get subtracted. Basically 80 lakh minus 11 lakh, 69 lakh will become the post-merger earnings of A Limited from its own company. From T Limited, obviously they will be earning this. That is a target limited. I hope you understood. Everybody following? Yes, so tell me students, what is happening? What is happening is that A Limited, which was earlier enjoying EPS of 8 on 10 lakh shares, that means it was earning 80 lakh rupees earnings. Do you realize in that 80 lakhs, there must have been these non-operating incomes also of 110 lakh rupees invested somewhere on which you are generating a 10% return. But now do you realize post-merger, you will not be able to generate these returns. Why? These returns which are already embedded in the 8 rupees, you will now not be able to generate or enjoy. Why? Because 110 lakh rupees worth investment you are breaking off to pay off the shareholders of Target Limited. Therefore, on 110 lakhs, 10% interest you lose every year. Everybody following? So from that 8 into 10 lakhs, 80 lakhs earnings, 11 lakh rupees interest I remove, because that I will no longer be able to earn. Everybody following? And apart from that, obviously we will be also earning the Target Limited's earnings also in the post-merged firm. Everybody clear? So students, tell me now, how do I solve this? Very simple now. Do you realize it will be 10 lakh into 8, that is 80 lakh, minus 110 lakh into 10%, that is 11 lakh, plus 5 lakh into 2.5, that is 12.5 lakh. The whole upon 10 lakh will give us the post-merger EPS. Okay. So on the calc now, 80 minus 11 plus 12.5 divided by 10 will give us EPS post-merger revised as 8.15 rupees. Now students, tell me what to do with this post-merger EPS. Do you realize post-merger EPS we have, post-merger PE ratio we have, post-merger EPS of 8.15 into post-merger PE ratio of 12.5 will give us the post-merger MPS, and then we will be able to find out the gain or loss for the shareholders of acquiring company. So students, 8.15 post-merger EPS into 12.5, that is the post-merger PE ratio, will give us a post-merger MPS of 101.875. So students, a shareholder owning one share of acquiring company earlier was having a wealth of rupees 100. Now the share price swells up to 101.875. There is a gain of 1.875, rounded off to 1.88 rupees per share to the shareholders of the acquiring company. As far as shareholders of Target Limited are concerned, they are straight away earning rupees 2 per share gain, because for 20 rupees share they are getting 22 rupees cash. Everybody followed? So with that students, we complete the calculations of this second part also, where we calculated the gain to the shareholders of both companies, again under a different PC, purchase consideration situation. Yes, so two big parts are there in this question, question 28. I hope you understood this question. I'll now flash the solution of this question on your screens. You can pause the video and copy down the notes. Thank you very much students. See you in the next video with a similar calculation sum. Thank you.